To Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Shauna Smith alongside Madison Mills, and let's get you the three things that you need to know this morning.
First up, U.S. stock futures pointing to small gains in the final trading day of 2024. Equities looking to snap several days of losses as the so-called Santa Claus rally has struggled to materialize. Today's cautious tone reflects lingering concerns about that small group of tech stocks that drove a lot of the gains for Wall Street this year. Still, the S&P, it's up 24% and on pace for its best two-year gain since 1998. And Wall Street expects those gains to continue. The S&P could rally an additional 19% in 2025, according to the highest estimate from Wall Street strategists.
But it was a bad year for the bond market. We've got bond yields surging this year. The longer-term yields on pace for their biggest four-year climb that we've seen since 1981. The spike in yields coming on the back of the Fed lowering rate cut expectations for the new year. Investors now expecting just 1 to 2 cuts in 2025. That was down from their latest expectations before the most recent Fed meeting of 4. Now, fixed income strategists on average expect the 10-year yield to close out the year at 3.8%. It's currently trading above 4.5%. Just this month alone, traders pulling $5.3 billion from BlackRock's iShares 20-plus year Treasury bond ETF, putting monthly outflows on track for the highest levels that we've seen in the fund's 22-year history.
Plus, a hack at the U.S. Treasury Department. The agency was hacked by a Chinese state-sponsored actor through third-party software service provider Beyond Trust. That's according to a letter the agency sent Congress on Monday. In that letter, the intrusion was called a major cybersecurity incident. A Beyond Trust spokesperson said Monday night that a limited number of customers were involved. The spokesperson added that law enforcement had been contacted and the company was supporting the investigation. In an emailed statement, the Chinese embassy in Washington did respond, denying any involvement. Stocks had a record year in 2024. The S&P 500 up about 24%, notching 57 record closes. Wall Street's most bullish forecasters couldn't keep up with the market's climb, many of them updating their year-end expectations for the index as recently as October. So what does this tell us about what we can expect in 2025 and what will drive those gains? The biggest thing to point out is that we're already seeing earnings estimates driven higher, particularly for some of those big tech names. But I think we've got a really cool lesson in our Wall Street Bull for 2025. John Stolfus, friend of the show, he's expecting, according to his price target, that 19% gain for 2025. In 2024, his price target for the year was surpassed just in the first 3 months of the year. And we saw that continuing across so many different strategist desks that they were just not bullish enough for 2024. So maybe 2025 is the year where they say, hey, let's actually just outpace the bullishness and get ahead of this with extra bullish and optimistic price targets.
Yeah, Maddie, it's going to be such an interesting year when you look ahead to 2025. So much question just about the momentum trade that we have seen certainly play a massive factor, at least within the last couple of gains that we have seen over the last couple of months. And when you take a look at what happened in 2024, right? Obviously, you had the U.S. election. That was a huge factor. You had the Fed starting its rate cutting cycle. That clearly was a market moving event. You also had the escalating geopolitical tensions, which of course was on investors' minds. Just some of the factors that have contributed here to the moves that we have seen over the next 12 months. But as you look back at the last 12 months and maybe try to figure out what exactly this signals going forward, you mentioned that earnings growth, and I think that is key because that's really what strategists have been telling us here over the last several months. That clearly is seen as the driver here, or a necessary driver, in order to keep this momentum here to the upside. We have talked to a number of strategists. John Stolfus, just one of them here on this show, Ed Yardeni, also recently, Brian Belsky in the past, just talking about why they do remain bullish and why they do see those further gains here on out. And I think that this is so important, especially when you take a look at what is happening, whether or not we're going to get this Santa Claus rally. Obviously, only time is going to tell. We have 2 more trading days left in this. But even if we don't get it, it might not matter. And I think that's so critical here, at least for investors to understand. Yes, January will likely be volatile here, at least until we do get some clarity on Trump policies following the inauguration. But looking ahead, there are still a number of reasons to be bullish. And on top of that list is very much the expected earnings growth.
And to your point on Trump policies, some of the folks we spoke with on the show yesterday said that those corporate tax cuts are what they anticipate leading to more earnings growth in 2025. But we don't know that that's at the top of Trump's priority priorities list. We've heard that tariffs and immigration are perhaps going to be first on the list. So what will stocks and what will the impact of those policies mean for stocks moving forward is a key question.
Yeah, and also how much of it is going to be driven by the AI trade when you take a look at the gains that we are expecting here for 2025. Yes, it's expected to be, at least from strategists' forecast, expected to be another strong year, maybe not as strong as what we saw in 2024. But again, when you take a look, at least from Oppenheimer's office, they're still expecting significant gains for the S&P in 2025. It's a good year for stocks, but not so much for bonds. A change in Fed rate expectations for 2025 prompting a sell-off in treasuries. So now the time to buy higher yields, or is more selling ahead? We want to bring in Mark Cabana. He is Bank of America Securities Head of U.S. Rate Strategy. We also have Janet Rilling, Allspring Global Investments Senior Portfolio Manager and Head of Plus Fixed Income Team. It's great to have both of you here. Janet, let me just start with you. When you take a look at the spike that we've seen in yields, clearly the bond market signaling and very much what they expect the Fed to do when it comes to the rate cutting cycle next year. What do you think is mostly driving that upside, and maybe what that signals looking ahead to the new year?
Yeah, certainly we got a lot of information from the Fed at the last meeting. They did have a cut in rates, but it was a hawkish cut. Powell guided the market to a slowing outlook in terms of rate cutting cycle. He acknowledged that growth came in stronger than expected. Employment picture was staying more solid, and that inflation was maybe not coming down as quickly as they'd hoped. So I think that's really what caused a large reset for both the Fed participants and the market. So as we look forward, I think one or two rate cuts for next year is sort of a base case. But the market and the Fed are going to be highly data dependent. The Fed has said that all along. And if the data starts showing a bit of a different narrative, if inflation is not moving lower as they'd hoped, I think we have to look at maybe a pause or a continued pause in 2025.
And Mark, jump on in here. What is the bond market telling us about what Janet is saying, particularly when you consider that the average call for the 10-year for 2024 was that we would end around 3.8%. We're obviously ending around 4.5% as it looks right now in the trade. What does that indicate to you about what the bond market thinks about what's next for the macro environment?
Sure. Well, first of all, happy New Year's Eve. Thanks so much for having me. I think that what the rates market is telling us is that it anticipates that U.S. economic growth is going to continue to be quite strong going into 2025. Certainly, calls for a faster U.S. economic moderation were unwarranted earlier this year. And that's why the rates market has priced out so many cuts from the Fed. It's, again, now pricing in just under 2 cuts for 2025. But the market seems to have relatively low conviction in that and is going to continue to be very, very data dependent, as the Fed will be too. For us at B of A Securities, we anticipate the 10-year ending 2025 at 4.25%, so above where consensus is, but slightly below where we are at this moment. Our house view is still for 2 cuts from the Fed next year, though there's relatively low confidence in those. But we do think that bond yields will be moving slightly lower because we anticipate a bit of a further economic moderation. And we also anticipate that uncertainty about the outlook, what will exactly those new economic policies be around trade, immigration, fiscal policy, and regulatory policy? How will those things shape up? None of us really know right now. And we do anticipate that that uncertainty will weigh on activity to some extent, and that will help push bond yields a bit lower over the course of the coming year.
Mark, what's the bigger risk factor here going forward as you look ahead to 2025? Is it what the Fed does, or is it more so what's coming from the incoming administration and what those policies look like?
Yeah, well, look, fixed income investors are going to be ultimately responding to the data as it comes in. The Fed is extremely important in terms of how it impacts bond yields. But the Fed is ultimately going to be determined by the data, and the data will be heavily influenced by the economic policy set that we get as well. Right now, I think that the market has a pretty good understanding of where the Fed is and has a very good understanding of where the economy is. But the big question mark is, what are we going to see in terms of those economic policies? And right now, that's where we strongly sense the market's focus is at the moment.
It's a really interesting backdrop, Janet, and I'm curious from your perspective if you can talk about where you see the most opportunity within fixed income. You talk about in your notes you sent over that this is the environment where active management can add value. Why actively manage when you can just sit in the 10-year and get 4% yields?
Yeah, if you start at the top, certainly it's an attractive time, we think, for fixed income investing because yields are higher than they've been in quite some time. If you go back to, for example, January of 2021, a quarter of all global public bonds were trading with negative yields. So we're at a point where almost 90% are trading with yields greater than 2%. So we think now is a good time to allocate to fixed income, but not indiscriminately. Certainly, you can allocate to higher quality parts of fixed income to harvest most of that yield. We do think you should still have an allocation to corporate credit, but credit spreads are quite tight. So here we think you should proceed with caution. For example, in investment grade corporate credit, we like the BBB part of the market because we feel that the economy is going to support those types of companies and you get some incremental yield there. In high yield, we think a more measured allocation, tilting your portfolio more up in quality to BBs and shorter duration. And then outside of corporate credit, something like structured product is an area that is quite high quality and gives you some incremental yield. So having an active manager that can help with those allocation decisions, we think is very prudent in a market like today, where portions of it, like corporate credit, are quite expensive.
How about you, Mark? How are you advising clients?
So we are advising clients to essentially anticipate that rates are going to probably be range bound over the course of this year. And we think that clients need to be tactically trading what we anticipate to be a range on the 10-year between 4 to 4.5%. Given that we're towards the upper end of that range right now, we think it's a good time to be adding duration. And we believe this because we anticipate that the U.S. economy will be relatively resilient. We don't see any signs of a material slowdown, but we also anticipate slightly lower yields, primarily as a result of that uncertainty as we move into next year, which I noted earlier.
Mark, lastly, what are you anticipating in terms of global demand for U.S. Treasuries, and what does that indicate to you heading into?
Yeah, it's a great question. So over the course of 2024, we saw that demand was better than feared, let's say. The number one question we typically get from clients is who's going to buy the bonds and what's foreign demand going to look like. And we've seen that foreign demand was reasonably resilient, though the buyer base has changed. Think less China, more UK, more European, more Cayman type of investors. And we anticipate that that environment will likely hold over the course of 2025. It will also really help if the Fed can ultimately guide the market in a little bit of a better place, such that the yield curve can steepen a bit further. And if that does indeed happen, then we think that there will be increased attractiveness of U.S. Treasuries to foreign investors as that yield curve starts to steepen out and as it starts to make sense for foreign investors to think about buying U.S. Treasuries, especially if it's on a somewhat FX hedged basis. Right now, Japanese investors don't have a lot of good reason to buy Treasuries, but as the U.S. yield curve steepens and as the Fed ultimately ends its rate cuts, that environment will change, and we expect to reach that point at some time in 2025.
All right, Mark, Janet, great to get your insight. We have to leave it there. Thanks so much for taking the time to join us, and
Thanks for having us. Happy New Year.
The U.S. Treasury is saying that Chinese hackers breached its security system in an attack officials described as a major incident. In a letter to lawmakers, a spokesperson for the department wrote that, quote, a threat actor accessed Treasury workstations, obtaining unclassified documents during the breach. The department saying that it was made aware of the hack on December 8th and attributed it to a China state-sponsored actor. Officials confirmed the compromised services have been taken offline and said that they are still investigating the breach's overall impact.
Chinese officials deny the allegations. A foreign ministry spokesperson called the claims groundless, adding that China consistently opposes all forms of hacking, and we are even more opposed to the dissemination of false information against China for political purposes. That pointing to a key question heading into 2025 about tensions between the U.S. and China and what that relationship could continue to look like. Coming up here on the Morning Brief, we're going to count you down to the opening bell on Wall Street on the last trading day of the year. Plus, a look at some of the most volatile stocks this year. We'll walk you through those. We'll also take a look at some of today's trending tickers. Stick around for that next on Morning Brief. You're watching Morning Brief, brought to you by Invesco. Let's get to some of today's trending tickers, and you can scan the QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up here on the final trading day of the year, we're going to take a look at some of the most volatile names in the S&P 500. Topping the list this year, Supermicro Computer, which surged to a record high in March on the back of a booming AI product. But after the company's auditor resigned shares, let me repeat that. After SMCI's auditor resigned, shares of the company plummeted more than 80%. Other volatile names include Palantir, Tesla, and solar equipment maker Enphase. Now, what's really interesting here about SMCI, and that I was just thinking about here, is that I believe the company was up over 600% over the last 2 years, despite some of that extreme volatility. Obviously, that is not the case for SMCI year to date here. Certainly seen a different story when it comes to the stock, up just about 7% year to date, but soaring over 1,200% over the last 5 years. As part of that AI demand-driven story here, but then questions about the company's accounting measures really throwing cold water on that. And then we also haven't necessarily seen the executive changes that the street was looking for. Yes, their auditor did resign and they were able to work with a new accounting firm, but there were some calls on the street that there needed to be even bigger kind of capitulation from executives on the SMCI team. But I know we're also looking at some other volatile stocks on the year.
Yeah, Maddie, when you take a look at some of those other names, you've also got Palantir and you also have Tesla among the top three there. Then beyond that, we've actually saw Enphase is on your screen as well. Beyond that, though, many of the chip makers, when you take a look at Broadcom, NVIDIA, AMD, Intel, they were also among the top 25 most volatile stocks that we have seen in the S&P last year. So how do we measure this? It's compiled by measuring how far prices are varying here from the average. So that's really how this list was created, just to give you a little bit better context in terms of some of those, how far some of these stocks had been trading here over the last 12 months from their average. When you take a look at Palantir, clearly that stock has had a meteoric rise, to say the least, over the last 12 months. It was just added to the S&P 500 in September. So again, it's important to cushion that there. But then in addition to Palantir, you talk a lot about Tesla. That was a stock that has certainly been volatile, to say the least. We have gone, if you look at the right-hand side of your screen, ever since the election and Musk and Trump and their partnership and friendship and the role that Musk is going to play in the incoming Trump administration has been enough to stoke some of the excitement surrounding Tesla here over the last 2 months. And you have seen staggering year-to-date gains here in that name, a name that had been struggling here as part of the Mag 7 here prior to then. So again, when you take a look at these names, many of them are tech. Many of them are within the AI trade, and I think that very much just tells us about how investors are viewing some of those investment opportunities right now, the risk associated it when you talk about the risk on trade or risk assets and some of the volatility that we should then also be prepared to see carry into the new year as well, and just beyond what we've seen over the last 12 months.
And you mentioned Palantir. That was one of the top 3 performing stocks year to date for a while, but then we saw that stock kind of dropping off in recent weeks here and be replaced by the likes of Vistra, that is the best performer of the year, followed by NVIDIA. So it's been interesting to see some of those names really outperforming and then coming off of that just a little bit here.
Let's take a look at another mover here this morning. Billionaire Bill Ackman saying that he expects Trump to privatize Fannie Mae and Freddie Mac. In a lengthy post on X, Ackman suggesting that the two government-sponsored enterprises could exit conservatorship in the next couple of years and be privately held again. So let's talk about exactly what this means. Obviously, the government does have control or oversight here of Fannie Mae and Freddie Mac. So this could potentially, Ackman is arguing, return it to a private management here. Ultimately, why this could be done, he's saying that this is something that Trump looked into in his first term with Secretary Mnuchin showing some interest on this. He ultimately ran out of time, and he sees this as a potential deal or something that Trump would be very interested in during his second term. In terms of putting some of the values here on this, estimate of value, or I should say Ackman's estimate of the value of each company at the time of their IPOs in potentially 2026 would be around $34 a share. I do want to point out in the last line of this post, he does make the comment here that there remains a high degree of uncertainty about the ultimate outcome, so you should limit your exposure to what you can afford to lose if you do choose to invest. But obviously, Maddie, when you take a look at whether or not this is done, if it is done, it could potentially reshape the real estate landscape. It could potentially reshape or affect mortgage accessibility there. And then obviously, Ackman does have something to gain if, in fact, this were to be true.
Right. His fund has owned shares in these firms for over a decade. So certainly seeing a lift to his fund at the end of the year off the back of this post. But I also think it's an interesting broader story about perhaps why the street was so optimistic about the Trump win in the first place. Obviously, we saw that playing out in the broader market, but also in some of these individual names, you continue to see this idea from the bigwigs on Wall Street that with one post, they can move the administration. And I think what would be a huge story for 2025 is how true that is. How close do you have to be to Trump's inner circle to actually be able to push for some of those policies? One example of that is the reversal of the TikTok ban, which Trump has waffled on a couple of times. Does a similar theme play out amongst individual billionaire hedge fund managers who are able to kind of get the Trump administration on their side is a big story that we're going to be watching for 2025. Finally here, shares of Sangamo Therapeutics taking a hit after Pfizer terminated its co-development agreement with the company to develop a hemophilia treatment. Sangamo says it's exploring all options to advance the program, including looking for a potential new partner. It was really interesting this morning taking a look at some of the biggest movers and seeing Sangamo stock sinking over 55% at 1 month in the trade. You can see here over the past month, that leaves it down just about 3%. So not a terrible performance when you look out more long term here. Obviously, huge outperformance over the past 6 months, up over 550%. But the lack of positive results coming from this phase 3 of their trial here with this gene therapy partnership with Pfizer, certainly disappointing and points to potentially some of the more broader challenges in the healthcare space when it comes to just the development of these drugs, the expense of that, and then what happens if it doesn't work out.
Yeah, TD Cowen was out saying that they are disappointed in Pfizer's decision here is likely driven by limited commercial success here for the drug potentially. So again, just going back to the complexity, how much it costs, what exactly that pipeline looks like. One of the reactions out from the street here this morning that did catch my attention was from Barclays. You have Gina Wang over at Barclays saying that Pfizer's decision to discontinue this is a, quote, big surprise, but it should have limited impact on valuation. So when you take a look at the stock reaction this morning, at least when you take a look at shares of SGMO, the fact that they're off over half or over 50% there, 53%, saying that that is a bit of an overreaction there, and does see the fact that this is a little bit more, I guess, safe to say it's overdone, and the street's taking a little bit too much of a pessimistic view on this. But again, Pfizer ending the gene therapy deal here with Sangamo, and you can see this, the shares reacting to that here this morning. Well, coming up, it's the last opening bell of 2024. Stay tuned. We've got that for you when we return.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
And that's we're waiting here for the opening bell in just about 5 seconds from now as we start the final trading day of the year. You've got Planet Fitness ringing the bell at the New York Stock Exchange. You also have some excitement playing out in Midtown Manhattan at the Nasdaq here. We'll see whether or not we see a reversal here from the last 3 days of losses for stocks. As we do see stocks, they have lost some of their momentum, but as we do start today's trading day, at least you have the Dow starting here to the upside, and this is brought to you by Invesco. You've got the Dow up just around 0.2%. Taking a look at the S&P, the final trading day of the year, up just about 0.2% as well. Again, we will see whether or not some of this momentum that we have seen percolate here in pre-market trading, whether or not that carries over throughout the rest of today's trading day. You've also got the Nasdaq opening in the green here this morning, up just about 0.4%. Let's take a look, though, at what has really transpired over the last month or so. So when you take a look at the last month, you're looking at a bit of a different picture. You have the Nasdaq, though, is still looking at gains here. But again, when you take a look at the S&P 500, well off the highs, and you can see the S&P off just almost 2% here, falling below that 6,000 threshold that it did cross above earlier in the month, and you can see trying to regain some of that momentum. Also, when you take a look at the Dow clearly in the red here for the month of December, and taking a look at the year to date and what we have seen in that and how that has played out. You've got the Dow up just about 13% year to date, the S&P up around 24%. Obviously, another strong year here. Looking at the strongest 2 years that we have seen here for the markets, for the S&P in the last quarter century, to really put some of those gains in perspective. When you take a look at the Nasdaq was the outperformer of the three major averages. The Nasdaq Composite up just about 30% year to date. A lot of the momentum, a lot of the excitement that has played out in the markets over the last 2 years, and we've seen that carry through here, at least the last couple of trading days, has been the tech sector. And we can see that has really fueled some of the gains that we saw in the Nasdaq as we've seen the AI trade really take center stage once again. Let's take a look at the sector action for the day. You're looking at gains. All 11 of the S&P sectors trading to the upside. You got real estate and consumer discretionary among the top performers here of the day. Month to date, though, again, a bit of a different picture. Lots of red on your screen as we have lost some of that recent momentum. You've got energy among the worst performers there, off just around 6%. Materials down about 7%. Communication services also off just about 4.6%. But when you take a look at year to date, again, we're certainly seeing mostly green on the screen. Communication services, financials, consumer discretionary among the outperformers, as well as technology. You got the XLK up just about 22% year to date. So again, we will see whether or not some of the forecasts that we're getting here from strategists for another strong year in 2025, whether or not that's going to come to fruition, Maddie.
All right, it's time now for today's strategy session. The Santa Claus rally could fail to materialize this year, but don't panic yet. We haven't had a Santa rally in the past 2 years. The S&P still rose more than 20% for both. Joining us to break down the technical indicators and what they're telling us for the year ahead, we've got Adam Turnquist, LPL Financial's Chief Technical Strategist. Adam, great to have you on. So we may not get Santa this year for the markets. What does that tell us about performance to come for 2025?
Hey, good morning. Happy New Year, and glad to be here. We're getting close to that end of the Santa Claus rally period. For those not familiar with that, it's the last 5 trading days of the year plus the first 2 trading days of the year. So that wraps up on Friday after market close. Of course, the level we're watching on the S&P, 5974. That would trigger a positive Santa Claus rally. And why is that important? It tends to produce positive January returns and a positive year for the following year. On average, when you get a positive Santa Claus rally, the S&P 500 up over 10% higher, nearly 3/4 of the time. When Santa brings that lump of coal and you get a negative Santa Claus rally, average annual returns over the following year only at 5%. So pretty big contrast between when Santa shows up and he doesn't show up. So we'll see how that plays out by Friday.
So, Adam, what should investors then expect for the month of January? How much volatility should they be prepped for? Could we potentially see some sort of catch-up trade?
I think it's going to be a return to normal volatility. If you look at 2024, it was very low volatility. We only had an 8.5% drawdown maximum on the S&P. Historically, that is very low when you look at the average drawdown for any year, about 13 to 14%. So a lot of up days, a lot of record highs, a very low VIX, we think volatility will return. Maybe it happens in January. That tends to be a positive year for stocks. Average return for January up, I think, 1.4% or around that level. So we'll see if this momentum, longer term momentum, continues. But we expect more of a average year for stocks. The 20+% returns is not in our forecast. We just went out with our outlook earlier this month, called it pragmatic optimism, and we think that really sets the tone for 2025.
How do you maintain the ability to have pragmatic optimism when you have such a bullish street surrounding you and so many other bullish price targets, given some of the potential earnings estimates to come for some of these big tech names that have really driven so much of the gains so far?
Good question. And I think when you look at our outlook for next year, we're talking mid to high single-digit type returns for the S&P 500. And some of that sentiment that you referenced, everyone seems to be all in on equity markets. We just had the largest quarterly increase in sell-side strategist price targets for the S&P ever. At least data set goes back to late 1999 or the late 90s. So everyone seems to be forecasting a pretty bullish outlook, and I think for good reason. When you look at the economy, has been relatively resilient, holding up better than most people expected, inflation moving in the right direction, and then look at corporate America delivering what could be double-digit earnings growth for the fourth quarter, near record high profit margins. But how much of that good news is priced into this rally that we're seeing, especially when you look at the political environment as well? A lot of rosy expectations for tax reform and more of a pro-growth agenda. We'll see how that gets delivered and when President-elect Trump takes office in January.
Adam, how big of a challenge do you see the bond market here in the steady climb that we've seen in yields?
I think that's muddying the macro conditions right now. We had a big breakout technically on the 10-year going through resistance at 450. It's above a rising 200-day moving average. So from our technical view, that does suggest there is upside risk, maybe to 474 or even 5%. And the dollar is tagged along for that ride as well, breaking out of a major consolidation range, potentially entering a new uptrend. I think it's going to be really interesting to hear some of the commentary in earnings season about the dollar, and if that's acting as a headwind potentially for some of these multinationals. I think around 40% of S&P 500 revenues come from abroad. So it's certainly something we're watching and an important factor that plays into 2025.
And Adam, in the notes you sent over, you mentioned the impact of the incoming administration's policies. And one thing we've been talking about is that we may not get those corporate tax cuts in 2025. We could, but we don't necessarily know yet. How much of the market gains are really driving and based on the potential of that specific policy?
I think it's one factor, and I think most of that news, or at least the baseline expectation, is that we'll get the extension and more of a reduced tax environment. I think the matter of fact is when we get that type of policy and how. There's a lot of uncertainty, and I think going back to our earlier discussion about volatility, that could be a major driver of volatility as we navigate around Washington, what may or may not happen next year.
So Adam, talk to us just about how investors should be positioned. When you take a look at the leadership that has transpired over the last 2 years, clearly a lot of the gains have been driven by tech. Is that going to be the winning trade here as you look ahead to 2025?
It's hard to bet against big tech. I think we've had this excitement in small caps. Even if you flash back to December of last year, we had a lot of strategists coming out. It's going to be the comeback year for small caps in 2024. Unfortunately, that did not play out, and it's been that large cap, big tech leadership. If you look at, for example, the Mag 7 index, that just broke out not only on an absolute basis, but also on a relative basis. If you look back, it really hasn't done anything since the summer. We're now seeing that leadership reassert itself with those mega cap names. Of course, on a near-term basis, some of them got a little bit overbought, coming off the boil a little bit, but the longer-term trend suggests leadership there is going to continue.
All right, Adam Turnquist of LPL Financial, thanks so much.
Thanks so much.
It's time now for the chart of the day. I want to take a look at the greenback, the dollar posting the best year, on track for its best year since 2015. Here you can see those gains of nearly 7.8% on the year, coming off of a year to the downside in 2022. Primarily driven by just the run up, the gold that the greenback had and the reversal that we've seen off of that. Now, what's really interesting here, Bank of America had a note on the outperformance of the dollar, and they do expect those gains to continue in the first half of 2025, but they expect a reassessment in the second half of 2025, and that is based on the digestion of the path forward for the Federal Reserve. Typically, we see yields moving to the upside and the dollar moving to the upside off the back of any hawkish commentary and hawkish movement from the Federal Reserve. So that's another reason for retail investors, even if you're not invested in the dollar necessarily, it's a good measure of what the market is anticipating for the Fed moving forward. Now, what could drive the dollar in 2025? A couple of risks Bank of America points out here. Central bank hedging globally. We could see demand picking up for all assets, the likes of Bitcoin in particular, could be a competition point for the dollar. We're also seeing global declines in dollar purchasing already. So if we do continue to see that, that could be another challenge for the dollar moving forward. But higher yields, that could also lead to a higher dollar. Inflationary policies could lead to more movement to the upside for the greenback, and that could potentially put pressure on equities, though, according to Adam Turnquist, who we just had on, the idea that yields are going to add some big pressure point to equities, not necessarily true in his view. So maybe we could continue to see both the dollar, yields going up, and stocks, all of it going up together as we do head into 2025.
All right, Maddie, thanks. Coming up next here on Morning Brief, we get an analyst take on the outlook for airlines on the back of their upgrade of American and what it says about travel expectations in the new year. Speaking of travel and the new year, you're looking at a live shot of Times Square gearing up for its New Year's Eve celebration later on tonight. And New Year celebrations are already underway across the globe. These are the celebrations in Sydney, Australia, as the clock struck midnight. Those fireworks are playing out over there, soon coming here to the U.S. in just over 12 hours from now. We got much more coming up ahead on Morning Brief. A record number of travelers are expected to fly next year. Passenger numbers are expected to hit 5.2 billion in 2025. That will be up 6.7% from this year and passing the $5 billion mark for the first time. That's according to the latest numbers, projections that we've gotten out from the International Air Transport Association. Now, amid the improving demand backdrop, our next guest upgraded American Airlines to outperform from market before updating her earnings forecast, taking into account an improved revenue environment. Let's talk about that and more. We want to bring in Savi Saith. She is a managing director at Raymond James. Savi, it's great to have you here on Yahoo Finance. Let's start with your call on American. It's one of the things that stuck out to us here in the market this week. You raised your rating on the company to outperform, saying that it has an attractive risk-reward profile. Talk to us a little bit more about why you're seeing such an opportunity for American at this point.
Hey, Shauna, thanks for having me. Yeah, what we see here is generally a kind of a demand environment that's holding. It will really depend on the economy. But there's also just in the industry itself, some capacity discipline that's coming in to help right size some overcapacity that we saw in 2024 and we've seen for a little while here. On top of that, what you've seen at American is a competitive capacity environment that's quite constructive for them. And also they shot themselves in the foot with some corporate policies that they had or policies that they had for corporate travelers that they've started to unwind. And that created issues last year. And we're seeing kind of decent traction that they'll start to see that, revenue stream recover in 2025. So a good industry backdrop and some self-help from American, which is already, I should point out, doing really well on the operations front and improving it relative to, pre-pandemic. So we see a kind of a good setup here overall.
You also note that one of the potential drivers and tailwinds for American could be the U.S. economy and the strength of the U.S. dollar. Talk to me about how that currency impact could be a positive piece of movement for American heading into 2025.
Yes, Sonny, the U.S. point of sale to international has been really strong for a few years now. Not sure, it probably has a lot to do with the strong dollar, but there also seems to be a renewed kind of interest in traveling internationally post-pandemic. And so right now the dollar is strong, so we think that continues. Around 25 to 30% of Americans' revenue is driven by international travel. So I think that's a really good setup there, and the current strong trend looks to be continuing into 2025 as well.
Savi, what about the regulatory aspect? Does that risk decline? And I guess, how does the M&A factor into some of your projections for the new year?
Yeah, it's a really good point. We don't know what the new administration's plans are yet, but generally, I think the sense is a little less regulatory risk than we've seen with the current administration. And even from an M&A standpoint, it will depend on the specific cases, but we think between the kind of the new administration stance as well as generally some of the smaller airlines struggling, there's a better chance of M&A. Now, that's not in our numbers and would be upside if we get a little bit more, capacity that gets right size as a result, or even existing airlines that strengthen their position as they kind of partake in M&A. So I think that's upside to the group and definitely a higher likelihood in 2025 than we've seen these past few years.
And another theme we've seen play out in the airlines this year has been a push towards a more higher income consumer model. We've seen that across so many of the airlines. Just curious how you kind of rate that strategy and how you think that will play out and benefit some of these airlines when it comes to earnings this year.
Yeah, how I look at it is it's not necessarily catering to a higher income consumer. If you look at who travels, it tends to be more middle income and high income households. But what you're seeing is airlines offering more product that consumers might want to buy up to. And there seems to be a desire to buy up into those products. And so I think they're leaning into that. You saw this trend even pre-pandemic, where airlines were starting to offer more kind of premium offering, and premium, comes in many styles. Right now, anything that's not next to the back of the plane seems to be considered premium. But there's extra leg room, there's first class, there's premium economy. There's also kind of first class on ultra low cost carriers, which is a slightly different offering. But clearly there's a desire among travelers to pay a little bit more to get a better product, and the airlines are leaning into that, and you're seeing a more aggressive push here next year.
And Savi, when you take a look at a little bit of a maybe medium to longer term basis, you've got Delta as your top pick. What gives Delta the edge?
Yeah, I think what we like about Delta is really the balanced approach that they have here. They have good domestic exposure, good international exposure. That balance sheet strategy is really smart in our opinion. Very balanced capital deployment between investing, putting money back into investments and deleveraging the balance sheet. Their target of, less than 2 times or actually 1 times gross leverage, I think is a most conservative target that we've seen elsewhere. And they're really preparing for the next shock that this industry will have to face. And, anybody who's watched this industry knows there's always a shock around the corner. So I think from a risk reward standpoint, they're really well positioned.
That's a great point. If you can prepare for risk in the airline industry, it sets you up well. Savi, thank you so much for joining us. We appreciate it. Happy New Year.
Happy New Year.
Coming up, we're going to talk about how the Fed's updated dot plot could impact bank stocks. That's next right here on Morning Brief.
You're watching Morning Brief, brought to you by Invesco. Now, following the Fed's December meeting, markets are now pricing in fewer rate cuts in the new year, up to just 2. That was down from the previous forecast. Here to discuss how that rate cut path forward could potentially impact the banking sector, we want to bring Yahoo Finance's very own David Haller. David, it's great to have you. So certainly when we've talked about banks here over the last several months, there was a lot of optimism, to say the least, surrounding that rate cut path going forward and what exactly that's going to do in order to boost some of the activity that we've seen at banks. Does this then, I guess, make investors, strategists kind of second guess what that activity is going to look like?
Yeah, Shauna, so all else being equal, no recession and unforeseen wipeouts, elevated interest rates have been great for big banks, at least. And lower interest rates could be just as good. What really matters here for lending margins is the pace of cuts. And after the Fed's December rate decision and the release of their dot plot, which showed that they may potentially only cut as much as 2 times in 2025, that might ultimately prove a good thing. A slower pace allows banks to have a better yield on their margin. The yield curve has also changed in that longer term rates are now higher than the short term benchmark rate. And that is going to give them a better leverage. This also comes along the lines of investment banking seeing a rebound, and we've seen the rebound continue with rates at their elevated levels. And the expectation is that even with only a few cuts, that would continue to happen. So that's what we're paying attention to. But as far as the margins go, analysts are now kind of starting to look at 2025, and they're looking at it as potentially a record year for margins across big banks. And that obviously compares to what's been a really good 2024. So we're not talking about small numbers here.
We're not, and it's interesting because we are shockingly already heading back to earnings season. We're a few weeks out from the big bank earnings. What is the biggest thing that you're going to be watching, David?
Yeah, I mean, I think there's been a ton of optimism for 2024 and also looking into 2025, and there's a lot we don't know about 2025. But just looking at 2024, JP Morgan is set to have another year and quarter of record profits, breaking their historical record. So that's huge. And it's going to be good at most of the banks, even though it's not all going to be perfect. What we're going to be looking at is any kind of comments we can get about more about what the incoming Trump administration means for banks and their margins. And generally, it's been optimistic, but no one's admitting to having a lot of information, and we still might not by earnings day, but on specific topics, we might get more granular idea of what they're thinking about. That being said, I think with expectations set where they are, it'll be really important to continue to see if investment banking and also the effect of higher rates is going to play into things like consumer spending and also the commercial real estate market. Those two things also very important.
All right, David, got to leave it there. Happy New Year. Thanks for joining us. Appreciate it. That is going to do it for the morning brief. Stay with us in the next hour for more analysis right here on Catalyst. Thanks for watching.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the final trading day of 2024. Let's get you the 3 catalysts that we're watching this hour.
First up, it's the final trading day of the year. Stocks on track for their best 2-year period in a quarter century. Santa Claus rally struggling to materialize. We'll tell you what the action could spell for 2025.
Plus, we'll bring you the global outlook for commodities and tell you why Wall Street is projecting lower oil prices next year.
And we push ahead to what you can expect from the Fed in 2025 and whether the central bank will stick to its projections for rate cuts in the new year.
Let's take a look at some market headlines to start the hour, sponsored by Tasty Trade. Taking a look at the major averages, at least for today. We're seeing a bit of buying action here, a bit of a recovery from the last 3 days of selling. You got all 3 of the major averages at least in positive territory. For right now, we will see whether or not that holds. Again, today marks the final trading day, not only of the year, but obviously of the month as well. We know the month of December has proven to be pretty challenging here for the broader market. Flipping over to the bond market, taking a look at yields, we have seen the steady push higher in yields. We're seeing a bit of a give back here today. You got the 10-year yield off just about 2 basis points, still holding above that 4.5 level. And flipping over to Bitcoin, this has certainly been a winning trade of the last 2 months, but today you're looking at some gains, trying to get back to that all-time high that it reached not too long ago, right around 108,000. This morning, though, we're trading just above 95,000.
Just a few names driving the majority of gains for markets this year, with the likes of Nvidia, other tech names in the Magnificent Seven driving the Nasdaq and the S&P to record highs. Some of the best trades this year tied to the market are ETFs, and you even saw that those single name ETFs led to the best returns for ETFs focused on those single names. I'm talking the likes of Tesla and Nvidia. The reason I bring that up is because it's been fascinating to see just the boom in single stock listed ETFs. So many investors I've spoken with this year have talked about how weird it is to buy a stock via an ETF instead of just owning the stock itself. But more broadly, wanted to point to a couple of stats that we've been talking about, Shauna. $1 trillion poured into ETFs over the last year. U.S. equities are king when it comes to those ETF inflows. We've seen significant inflows into ETFs that are tracking the S&P 500 and the Nasdaq, and global demand for those ETFs also hitting records, continuing to add to this idea of U.S. exceptionalism and the idea that stocks that are listed on U.S. averages are really the ones that are going to continue to rally moving forward.
Yeah, and I think when you take a look at some of those fund flows and what exactly that tells us, clearly a lot of the excitement there pointing to technology, that sector at large. And then when you take a look at the individual movers, obviously Tesla has been a huge winner as of late. Nvidia, you might think it is the top performer here in the S&P 500. We've talked about it so much, certainly has been a driving factor here in this bull market. But when you compare that performance to other names of the S&P, it was actually the second top performer. You may even say third if you want to factor in Palantir. Palantir did join the S&P halfway through the year, so a bit of a caveat there. But again, this just points to that concentration, Maddie, that you've been talking about within the market, and where many of these gains, why we have seen these gains, or why we have seen some of that excitement play out. When you take a look even at Vistra, when you take a look at Nvidia, obviously the big factor there is AI, and the AI momentum has certainly carried a lot of that excitement this year. We've seen that not only play out in these individual funds, but we've also seen it play out in exchange traded funds in ETFs. And I think the question going forward is what exactly that growth rate is going to look like. And of course, when you take a look at earnings growth expectations, yes, we are expecting to see another strong year, but again, a bit of a cooling here when you compare it to some of the growth that we did see this year. So again, how big of a factor that's going to be in those future gains is something that Wall Street obviously is still trying to figure out at this point, and only time is going to tell.
Well, and it's fascinating too when you look at flows into some of the little bit more speculative assets. The last thing I want to bring up is the BlackRock Bitcoin Fund becoming the greatest launch in ETF history over the course of 2024 in just 11 months, because we don't have the final month data yet. It grew to more than $50 billion in assets. No ETF has ever had a better debut than that BlackRock Bitcoin ETF. So interesting to see that going up alongside the broader S&P 500, more traditional ETFs. Interesting question to watch in terms of whether or not there's a little bit of froth out there, or if we'll just continue to see more gains. across the board in 2025. Let's turn now to how you can get defensive in the new year if you are worried about all that concentration within tech. Joining us with more, we got Brian Zeitel. He is the Senior Managing Director and Partner at the Benson Group. It's great to have you on. So talk to me about how you are thinking about maintaining a value-based investment strategy when you can just really rely on these tech names for so much of the gains that we've seen, particularly in the past 2 years, Brian.
Well, I think that's it. You know, the gains have come from those parts of the market, and the valuations speak to that. These names, a lot of them that you mentioned just previously, are trading 50, 60, 70 times earnings. And so for us, it's just too expensive. We've had move up in markets now 20% 2 years in a row. A lot of it has been driven by that particularly one tech sector. And so we look at other sectors and some more defensive names that provide more of a return of cash flow, return of income in the form of dividends to support total returns going forward.
So, Brian, are you expecting a pullback? Or are you expecting more sideways action? I guess, how should investors be prepared then for the next 12 months?
So if I were to choose between the two, I'd say more the latter. But let me describe it this way. Earnings expectations for 2025 are somewhere near 14%. So that's pretty optimistic, and that's already baked in. We're trading at 23 times earnings. So I think you could get a lot of good things happening. You could get tax reform come through the Trump administration. You could have the 2 rate cuts that everybody's now looking at for the year happen, and you could have earnings in double digits and still have market have some multiple contraction. And so the part of the market that I think will be most affected by that will be some of those overvalued sectors that you mentioned. And so for us, it's not necessarily prediction of a bear market or a down market. It's just finding value and understanding where a total return is going to come from in the form of income more than just a multiple expansion or appreciation.
What should investors be looking at to kind of suss out those opportunities within value? Talk to us about how they should kind of be putting the microscope to some of the individual names they're investing in.
Well, I mean, if you're looking at it from a dividend perspective, a dividend growth perspective, which is how we look at the world, you're looking at businesses with high free cash flow that are paying out a consistent amount of that in the form of dividends, that have a very long track record of raising those dividends every quarter, and then have a fairly reasonable valuation along with a reasonable amount of payout ratio that is supportive of future growth of that dividend. So those are some of the metrics that we would look at. But it's not necessarily sector specific or market specific. We really do look at it business by business, and so company by company is the way I would approach it.
Brian, what would you say is the main risk for 2025 in the market?
I think it's expectations. I think good things can happen. I believe they will happen. So this isn't a negative comment. I think that it comes down to where valuations are already set and where those expectations are already set. When you're priced to perfection, markets tend to get disappointed. And so I would just say, keep that in mind. I don't believe chasing what has gone up the last 2 years is going to get you to where you need to be for 2025. This is the second move up in markets over 20%. Last time that happened was 1998. We sort of know what happened over the late 90s into the 2000s, into the aughts. So there's just a lot of things that rhyme with that period of time, with concentration risk in the market, with valuations. And I think this is a time to be a little bit more reasonable and sensible in the approach of how you're going to approach equities.
All right, Brian, thanks so much.
Thank you.
Coming up, we are taking a look at commodity prices, from gold's banner performance in 2024 to how oil could be a tailwind for Trump in 2025. We've got the details for you next. Gold is set to end the year with its biggest annual jump that we've seen since 2010. We've talked a lot about the excitement playing out in the gold market here. You've got prices up over 20% since the start of the year. As of this morning, that puts gold on pace to outperform many other asset classes this year. So let's talk about what's behind that move higher. Obviously, that safe haven appeal amid U.S. monetary policy easing, that, of course, has played a little bit of a factor. But, Maddie, one of the big driving factors that we've talked to so many guests here over the last several months has been central bank buying and how big of a driver that has been to prices going over the last 12 months. And then I think just going forward, the importance of that. And I say importance of that just in terms of continuing that move to the upside, because lots of questions about whether or not we are nearing a top right now for gold prices and whether or not it is really due for a pullback, given questions about that demand.
And if gold will continue to be the asset that central banks more broadly are looking at as a diversifier against the U.S. dollar, as we are starting to see the U.S. dollar continuing to hit record highs as well as gold. And as you mentioned, among the best performers when it comes to commodities in the metal space, not so much when you zoom out. You think about coffee and cocoa also being huge outperformers on the year. But it is interesting, the beginning of the year, a lot of the rally in gold was driven by some buying that we saw out of China, particularly as that economy continued to struggle. And I wonder if the stimulus efforts in China add a little bit of fuel to that type of buying as we head into 2025, or if a recovery in China actually is a headwind to gold moving forward. We have so many different macro factors that are driving the movement that we're seeing in this particular commodity, the China story being just one of those. All right, shifting to another commodity that we have been watching here. Wall Street analysts are largely expecting lower oil prices in 2025, with forecasts between $76 and $65 a barrel. Now, this could be a boon for the incoming President Trump, who has supported an increase in American oil production through deregulation. Joining us now for more, we got Rick Joswick, S&P Global Commodity Insights Head of Global Oil. We also have Leo Mariani, Roth Capital Partners Senior Energy Analyst. Great to speak with you guys this morning. Leo, I want to start with you. So you mentioned that some of the bearishness has disappeared recently when you look at 2025. What's driving that? Because it seems that the consensus has been a bearish one for oil heading into the new year.
Yeah, so I think if you look at it, WTI oil's traded better over the last couple of weeks, and I think really what folks are looking at are potential sanctions. They're going to increase maybe dramatically from the Trump administration starting in late January, which can pull some barrels off the market, most notably from Iran. There's also been a modest improvement in official selling prices in the Middle East as well from a few key countries there. And there's been some talk that some of the OPEC countries that overproduced in the last few years are going to make up for that a bit here in the first part of 2025 with some compensatory production cuts. I really think it's those three things that have improved sentiment a little bit on the margin of late.
Rick, what do you think?
Well, the key thing is that non-OPEC plus production is growing faster than demand for oil. So even if we have a cutback in some other areas, it's still likely that we're going to have more supply coming onto the market than there is the demand for that crude oil. And that means inventories are likely to build, especially in the first half of the year. So there still is this downward pressure that we expect on prices over the next several months.
Rick, is the market a little bit complacent at this point when it comes to pricing and what it's expecting? Yeah.
It really is. I mean, Dated Brent prices have been $74 plus or minus $1 since September. WTI has been about $70, virtually unchanged, within $1. The market seems to feel that there is a cap to the prices in that OPEC wants to increase its production. And there is this looming inventory build that everyone's expecting for next year. And there's also a floor to the production, because if prices drop lower, then you'd see less production out of the United States, and likely you'd see OPEC Plus acting to cut. So we're kind of caught in the middle here. The key question also is what Leo was just referring to, in that what happens with Iran, with sanctions on Iran? If things tighten up on Iran and they produce less, that would be bullish, of course, initially. But what happens with Saudi Arabia and with other countries? Do they backfill for that lost production? There's a lot of uncertainty in the market here, even with the complacency.
Well, it's really interesting, too, given what you were saying, Leo, about Iran specifically. We have geopolitical challenges in Russia, China, and Iran. Do you think Iran is the key one to watch for the oil market?
Yeah, I think so for sure. I mean, look, I think that's clearly the country that Trump's incoming administration has already been talking about in terms of where there could be even more significant, economic sanctions. There's been, talk of just kind of, very full sanctions on the country, even from kind of day one and day two of the administration. If you look at, Iran's oil exports right now, they're probably somewhere around 1.5 million barrels a day, plus or minus a little bit. So clearly, there could be a lot to lose, potentially if those sanctions are effective. And certainly there's going to be some questions around that in terms of, will key, buyers of Iranian oil abide by some of those sanctions? And we'll just have to see what maximum pressure means from the Trump administration. But certainly I think he's going to go after financial institutions that facilitate the trade of Iranian oil, as well as shipping companies as well.
So, Leo, what should investors then be expecting in terms of pricing? Here we are. We've been pretty range-bound here this morning, just above $71 when you take a look at crude. Are we going to remain within this range, do you think?
Yeah, look, so my official forecast, which has been in place for the last handful of months for 2025, has been $70 for WTI. So, very close to kind of where, current prices are today. I actually think you're going to see probably heightened volatility, particularly in the first quarter, just because of the uncertainty around what Trump can do. So obviously I mentioned sanctions, which I think clearly would be a bit of a positive, for oil in the near term. But then as Rick said, look, clearly if those do take place, there could be a ramp in OPEC production later on in the year to backfill some of those volumes. The other key thing to look out for will be tariffs. Tariffs can clearly be bearish, for the commodity, as it would certainly make, oil more expensive for a lot of the world to import, and would likely put further upward pressure on the U.S. dollar, which makes crude more expensive.
Rick, how big of a risk factor do you think tariffs are?
Well, tariffs are a risk in a lot of different ways, depending on how they might be implemented. Is it just a negotiating tactic? But if tariffs were implemented, let's say, on Canadian oil product exports, New England is supplied to a large extent from Canada. So that would be an upward pressure on gasoline prices in the United States, in the northeastern United States. If tariffs were imposed on Canadian crude exports, that would result in trade changes. Canadian heavy crude would go to China, and other crudes would need to be imported into the U.S. West Coast. So there's a lot of uncertainty here. How much of this is a negotiating tactic? If there's general tariffs of modest level, then it's more of a global economic factor, a lower trade, which would tend to reduce fuel oil use for shipping, diesel use for trucking. So we are not likely to see any dramatic changes in the physical side of the oil industry from tariffs, though.
All right, Rick, Leo, thank you so much for joining us. Appreciate it.
Thank you.
We've got all your markets action ahead right here on Yahoo Finance. Stick around for more. You're watching Catalysts.
Federal Reserve's December meeting, policymakers updated their closely watched summary of economic projections, including rate cut expectations for 2025. But what does history say about the reliability of the dot plot as to what it tells us about how reliable it is as a predictor of policy moves? Here with more on that, we want to bring in Yahoo Finance's Jennifer Schomburger. Hey, Jen.
Hey, Shauna, good morning and Happy New Year. The Fed has dialed back the number of projections for interest rate cuts next year to 2 from 4 previously in the face of what is expected to be more stubborn inflation. The Fed now expects inflation to end 2025 at 2.5% instead of a previous forecast for 2.2%. But just because policymakers project a certain number of interest rate cuts doesn't mean that those projections will hold. As Fed Chair Jay Powell has said in the past, the so-called dot plot, which is the compilation of each member of the Fed's forecast for where their benchmark interest rate will end the year, is a snapshot in a point in time. The central bank is highly data dependent. And this past year demonstrated just how much those projections can move around. In March, the median projection of 19 policymakers was for 3 cuts this year. That was dialed back to 1 cut in June, then up to 4 cuts in September. Officials ended up cutting 3 times, but with one 50 basis point jumbo cut, totaling 100 basis points of cuts and really matching the September projection. In September, policymakers projected 4 rate cuts for 2025. In December, that prediction went to 2 cuts. If Trump's proposed policies from tariffs to tax cuts cause more inflation, that could force the Fed to pull back even more on any easing or even reverse course and hike rates, though that is not the baseline. On the flip side, if Trump's policies lead to lower growth or threaten recession, the Fed could lower rates. Now, the last time Trump was in power and asserted tariffs, the Fed actually ended up cutting interest rates. Guys?
Well, Jennifer, it's interesting you bring up the relationship between incoming President Trump and Fed Chair Jay Powell. They've obviously clashed in the past. What do you anticipate that relationship looking like in 2025?
Maddie, it's absolutely possible we could see the two clash again, especially if the Fed does not lower rates as much as perhaps the president-elect would like, or even at all. And that is really going to be dependent on the course of inflation. And for sure, the president-elect's policies from tariffs to tax cuts, we'll have to see whether those could add to the inflationary picture. If it turns out the Fed continues lowering rates and stays on this course, then we could see more of a peaceful relationship. For now, it appears that tensions have cooled. The president-elect said on Meet the Press that he has no intention to remove Powell before his term expires in May 2026.
All right, Jen, before we let you go, let's talk about one of the big headlines coming out of D.C. here this week, and that is the upcoming vote on the Speaker of the House. We heard from President-elect Trump, who very much endorsed Mike Johnson ahead of this vote. Where do things stand?
Yeah, Shauna, this is typically a routine vote to re-elect the Speaker of the House. However, in this case, it appears there could be a bit of a hurdle because there is a very thin margin for Johnson to get reelected. He only needs a simple majority. As you said, the president-elect has endorsed Johnson. However, he can only afford to lose 1 vote. And we already know that Representative Massey has said he will not support Johnson. So that really leaves no margin for error. Now, the risk here is that we see multiple iterations like we saw with Kevin McCarthy. And if that is the case, that means that the new Congress cannot be sworn in on Friday or gets delayed. And it is also up to the Speaker of the House to certify the election results for President Trump.
All right, Jennifer, thank you so much for joining us. As always, we appreciate it.
Thank you.
We're going to have all of your markets action ahead, so stay tuned for much more of that. You're watching Catalysts.
Welcome to Stocks in Translation. I'm your host, Jared Blickery, alongside the intrepid Sydney Freed. You know her as the voice of the people. And first, some quick housekeeping notes. Be sure to like, subscribe, and comment on Stocks in Translation. You know where. And today we are welcoming Robert Slimer. He is a technical strategist at RBC Wealth Management. I met Rob at a CMT meeting a few weeks ago, and that's Chartered Market Technicians, their association. So it's no surprise that we're going to be digging into market technicals today. Our word of the day is cycles. We recently broke down the business cycle, and today we're going to be talking about the patterns that repeat and rhyme in the markets. And this episode is brought to you by the number 5%. That's the magic level for the 10-year yield that is both made and broken prior bull markets, while Uncle Sam's cost of money for the next decade is key to investing in 2025. And Rob, we're going to dig into market cycles in a second here, but just give us your big picture overview of the markets.
In general, the long-term view that we look at, we think of the market moving through these very long-term generational cycles. They tend to last 16 to 18 years. So if we think about the market moving from the 30s into that bull market of the 50s and 60s, that sideways pattern through the 70s and 80s, the bull market in the 80s and 90s, and then sideways through the early part of the 2000s, we're in that 2010 to 2020 bull market, and we think it has more upside in the 2030s. We think these are very long-term generational cycles.
All right, with that, let's just dig into cycle talk, and I'm going to give you the definition. This is, here we go. Market cycles are patterns of rising and falling asset prices that repeat over time, typically including phases of growth, peak, decline, and recovery. So I know you're following the 4-year market cycle, and it kind of aligns with the U.S. presidential cycle. Just tell me maybe first how you think about markets and why these things repeat.
Yeah, I think if we look at the generational cycles, these secular bull markets, structural bull markets that tend to last 16 to 18 years, within that, you have a series of higher highs and higher lows. If we think about that, what drives those market cycles? Well, it's central bank liquidity, and it's response to that liquidity by the economy and corporate earnings. So we can go back and look at these cycles, and they last roughly 4 years bottom to bottom. In general, as you go through time, again, the 50s and 60s, the 80s and 90s, and even the 2010s and 2020s where we are, you tend to have that similar pattern. It's not perfect. It's not going to be a cookie-cutter repeating pattern, but it's consistent enough that I think if you're investing, you have to think about these market cycles in terms of your investment process, because those 3 to 4 year moves are what most of us feel. Right? We had a huge correction in 2022, and that was roughly, 27% off the high to the low? Very consistent with your average 4-year cycle, which runs roughly 20-25% in terms of bear markets. And the average upside tends to be about 110%, which is a pretty big move off the bottom.
You're talking about the 4-year cycle. Where did that 16 to 18 year, generational cycle come from?
Great point. So let's step back and move away from those shorter term cycles and look at those generational long-term trends. So again, starting at the end of the Second World War, we had that move through the 50s and 60s, sideways through the 70s, right? So you have reflation in the 50s and the 60s, inflation in the 70s, disinflation in the 80s and 90s, more deflation in the early 2000s, and now I think we're in a period of reflation. So they may be driven by demographics, they may be driven by productivity, but I think we're in one of these cycles on the upside. Could last in the 2030s.
Yeah, and I just want to, and we'll talk about your prediction for prices in a second. That's really eyebrow raising, but let's think about, and I want to dial into this generational cycle, because for the average person, you're not going to remember, especially if you're a younger investor, you will have no basis to remember what's on the horizon because it hasn't happened for so long. And so we're always dealing with new information that's kind of new to our generation. How does that memory affect investors?
Well, that's a great question. I'm not sure, to be quite honest about that. I think if we just look back, we can see the patterns in place. I think that's the importance of looking at technical charts or just price patterns in general and having that perception. Look back, step back, and look at what market history has done. And from that standpoint, again, I think we're still in an uptrend. There hasn't been a lot of evidence of a breakdown, despite all the concerns about a recession coming. So far, so good. And so as long as that trend's intact, I think it's pretty important to invest in the direction of that underlying trend.
Let me ask, is a cycle similar or the same as seasonality? Because we talk a lot about seasonality on the show.
Well, I think there's cycles at all different time frames, right? There's annual cycles, there's 4-year cycles, there's trading cycles, there's tactical cycles.
How do you keep track of all these cycles?
Well, we look at a lot of charts. I mean, I spend most of my time. This is the
You should
exciting
see this
part.
man's chart book. We were looking at this yesterday on the phone. This gentleman has a lot of charts.
Too many charts.
About 1,500 charts on the weekend, just for fun. You know, that's
Yeah.
it keeps me on top of my game. But it all depends on your investment horizon. So if you think about your investment horizon, whatever that might be, you want to take into account what are the underlying cycles. Are you investing in the direction of that underlying trend, or is that particular cycle beginning to peak? So I think it's pretty important to pay attention to.
All right, your S&P 500 target for the end of the decade, and this is not a Dow target to the downside. This is an S&P 500 target to the upside. What is it?
Well, in the mid-20s, so this current cycle, we think lasts into the mid-2030s. That long-term structural secular bull market, those generational cycles. And so, you know, one of the things they tell you when you're a strategist, never put a date and a target on the same page. So we're going to do both just to shoot ourselves in the foot.
There we go.
If we really think about how this could potentially play out, the target for the S&P is 14,000. Now, I put that out in 2000.
It's 6,000 now, by the way.
Yeah, that's right. So I put that out in 2015 and was ridiculed in the press because the compound annual growth rate, the annual change that should have to happen to get you to that number was something like 14%. Now,
And guess what?
it's right 7 to 9%, more or less in line with the average trend for the market over an annual time frame. So it's not out of line at this point. It sounds like a big number, but
It sounds massive. So where is the downside? Like we do hear from some guests, like it's been good for year 3 of the bull market. It's been good for so long. How does like a downturn factor into this 14,000 target?
Well, again, let's think about that structural uptrend. It's going to take place over a period of time where you have some rallies and some pullbacks. We're 2 years into a bull market, right? The fourth quarter low in 2022 marked the bottom of the bull market or the bear market for equities. And now we're 2 years into it. So there is risk that the cycle starts to peak as we move into the second half of 2025 or even into 2026. And that's going to be year 2 of the election cycle. And often you have a mid-year cycle correction in the second year of an election. That would be 2026.
I would add, I think the third year of a bull market is a little bit weaker historically than the first two, but it's still supposed to be a bull market. Rob, I wanted to focus on some of the longer term outlook here, because the CMT meeting that you and I were at that I was referencing, I was a bit surprised at how bullish by consensus everybody was into the end of the decade. There's, short term, what happens? But into the end of the decade, where is this coming from your perspective?
In terms of the bullishness?
Yeah, in terms of the bullish.
I think the simple answer is the trend is up.
Okay.
And so people simplistically make the case, a force in motion continues in motion. And I think there's some reasons for that. I think generational cycles are still playing out. Part of that is demographics. We do have the biggest bulge in millennials moving through and into their household formation period. So that's potentially a catalyst to keep the market moving, along with, perhaps productivity gains.
So maybe.
Yeah, I was going to say, is any of this like sector specific or tech specific, any of this bullishness?
I think longer term, at this point, I think growth still continues to be an area. It's expensive. People worry about the valuations, and that could cause one of these mini cycle corrections. Again, roughly 20 to 25%. But I think longer term, technology and growth still is driving the stock market longer term.
I know you like China right now, but it's not really been great for investors. So
Last few years.
Yeah. So, how long is this going to last? Are we seeing more growth to the upside soon?
It's difficult to project how long it's going to last, but if we think about the bear market that's happened in China, it's now over almost 3 years in duration. Now, look, China is not appropriate for many clients, many individuals' risk profiles. So we want to be very careful here. But what matters about it from a technical standpoint is that it's a barometer for the second largest economy in the world. So again, we're not here promoting China as a place for people to invest, but what we are starting to see is signs that market is beginning to bottom. And I think that's a pretty healthy sign for the broader economy, for that economy, for the global economy.
What's also seemed to kind of take off very recently, maybe since the election, is unprofitable tech. So if I look at the ARC innovation components, and it's led by Tesla. Tesla is obviously a Trump play, but there are also a lot of stocks that have just been down and out for years that are finally starting to show life. Square is on your radar. I was writing about that a few weeks ago with one of our other guests. What does that look like to you?
Well, think about it. We had this surge in technology stocks off the 2020 low, off the pandemic low, and everything went up, right? As we like to say, right? Even turkeys fly in a hurricane. So pretty much everything rose in that bull market, and then reality set in. Interest rates went higher, and these stocks cracked, and they went into pretty ugly bear market. Some down 80, 90%. They went sideways for 2 years. And you're starting to see these stocks break out of these trading ranges. So from a technical standpoint, you're going from a bearish trend to a flat trend to a bullish trend. Now, let's be candid here. Some of those stocks are up 100, 150%, maybe more, depending on
from those very depressed lows. Yes, they can look impressive.
They're huge gains, and I would argue that many of those names have run a little bit hot in the near term and are starting to correct here.
Yeah, I mean, if a stock is down 50%, I think what a lot of people don't think about, it has to double in price to get you back there. You need a 100% return if you lose half. If you lose 90%, which a lot of these stocks did, you need a 900% return.
Yes. So, and they can trade in these huge trading ranges of between 100 and 200%.
Day traders love
years. But they've run pretty hot. I mean, I'd be careful putting new capital right here, right now. We've seen a lot of speculative names really run into the end of the year.
For your average investor who doesn't know so much about technicals, what's the best advice you could give them when they're trying to navigate their own portfolio?
Asking for a friend, Sid?
Yeah, we don't need to lie. I'm asking for myself. There's no friend.
Well, I think it's important to do your own research, right? Simply looking at the S&P, the mid-cap index, the 10-year bond yield, what is gold doing, what is the dollar doing, just a handful of indices, and paying attention to those, watching those on an ongoing, every week, is a useful process. So when you see news coming in, you can look at how the markets are reacting. We have a saying, it's the reaction to the news that matters, not the news itself. And so that's so important. I mean, think about the fourth quarter lows in 2022. We had that hot CPI print. The market sold off 2 or 3% and then was up 3% by the end of the day. And that was such an important signal. We still had inflation, but the market was saying that's probably the high point for inflation.
That kind of contrarian thinking is so important. We do need to hold that thought because we're going to take a short break. But coming up, we are going to be talking sovereign bond yields and the magic number for rates that seems to make or break bull markets. Plus, you might just get defensive listening to today's Who Wore It Better. Stay tuned. This episode is brought to you by the number 5%. Rob, you've been kind enough to share with us, data on the 10-year Treasury yield going back a full century, even farther. For whatever reason, when the rates are on Uncle Sam's debt, they get to 5%. Big things tend to happen. And you've talked about some of these long-term secular cycles up to 18 years in the market. How do yields play into that?
Well, everything is driven off of interest rate, the cost of money, right? For every company, for every individual, how much you pay for your capital is what drives your investment decisions. We don't have a huge sample set, right? If we go back to the early 1920s, and there's other data sets that go farther, but if we look at interest rates, they go through these very long structural trends, last 30, 35 years. When rates started to move up above 5% in the late 60s and early 70s, that basically was the end of the bull market, the equity bull market, that ran through the 40s and the 50s and the 60s. And equities went sideways, right? We were in an inflationary period, rates were above 5%, and the market moved nowhere. Very volatile, huge trading ranges, but it really didn't make any headway for a decade. So we have a sample set of 1, so we have to take that with a grain of salt. But that rebound that we saw in the fourth quarter of 2023 on the 10-year bond yield got to 5%, and that's exactly where it stopped. And that's where breadth in the equity market, small caps, mid caps, cyclicals really took off through the
was that the everything rally that we got last?
That was the everything rally, almost exactly at this time last year.
Makes sense.
Right? That sort of petered out by the time we got to the middle of the first quarter.
Sure.
Reevaluated their enthusiasm. But I think 5% is a very important number. If we look at where the 10-year is now, put a peak in at 5% in the fourth quarter 2023, another peak at 4.7 in April of this year, and another peak at 4.5 just last month. So we have this downtrend in place. We think the cycle has peaked on rates, but should rates start to back up, if inflation happens to come back, if rates start to back up between 4.7 and 5%, I think it's going to be very difficult for equities to make any headway. And in fact, I think it's a risk to the equity bull market that started in the fourth quarter of 2022 that it could abort if rates move through 5%. So I think it's a critical number.
So if 5% is too high, what is too low?
Great question. So let's think of this as rates being in a band now. They've kind of normalized is the term I think a lot of people want to say after these really low rates that we had in 2019 and 2020. So 4.7 to 5% on the upside. Think of that as 3.25 to about 350 on the downside. I think of above 4.7 to 5%, too hot. You probably have inflation. Below 3.25 to 350, that's probably the economy slowing down too much, and we probably have a recession. So very, very key technical levels.
What about the dollar? Because that kind of plays in with rates. Is that something you look at? People talk about the dollar wrecking ball, and that's a key phrase that we've broken down here.
I think rates and the dollar are hand in hand, right? They're either side of the same coin. If rates are going up, it's probably making your currency more attractive on a relative basis for investors globally. And on the trade-weighted dollar, the DXY index, that 107, 108 is a really critical upside level. I think if the dollar starts moving up above that level, along with rates.
What was on that level?
That is 107 to 108 on the weighted dollar, the DXY index.
Sure.
And so that's a pretty critical threshold, and it's bumping up against that level. I think it's stalling. I don't think it breaks through that level, but it's certainly one of those trigger levels that you want to be aware of for the dollar and for bonds.
So this is pretty helpful because now we have two key markets, two key levels, and you can just kind of figure out and back into what should I be doing with stocks right now, at least what should be framing my longer term thinking here. I mean, is that kind of how you see things?
It is. I think you want to stay fully invested as long as rates behave themselves and the dollar behaves themselves. I think if rates and the dollar start moving above those levels, it's a signal that something is out of whack or that something's starting to stress the equity market. So I'd be cautious at that point. That's the way I view equities.
All right. We've talked about yields and we've talked about the dollar. Anything else in derivatives land? Like, do you have your eye on gold? Any crypto at all? Any signals that we might get from fringe risk markets?
I think if we look at the bull market in gold, it traded sideways from 2011 through to 2024, just under that $2,000 level, and then took off. So it is still in a bull market. It's hit some technical levels. I don't want to go down the rabbit hole of what those levels are, but 2,800 was a very important technical resistance point, and call it 2,500 is a pretty important support level. So I think gold is just in the sideways consolidation. It ran really hot, needs to cool down a little bit. I think that's what's happening. When you look at crypto, again, it's beyond my sort of expertise, but if we think of that as a proxy for risk appetite, some of the crypto equities and cryptos themselves have run very, very hot here. And so I'd be very careful buying the equities at this point. They may consolidate, they may give you better entry points, but up at these levels, like some of those smaller cap and non-profitable tech companies, things have run really hot in the short term. I think investors need to be a little cautious putting new capital to work there.
How does an investor think about gold? Is it purely like a hedge? What is it an indicator of?
Yeah, it's a funny thing, right?
Yeah.
There's gold bugs out there. Sometimes it correlates with markets. You know, when we get into periods where there's a lot of stress in the financial system, everything goes down.
Inflation hedge, Armageddon hedge, kind of separate areas there.
It doesn't always work either. So,
and it depends what the Fed is doing, because the Fed backdrop and interest rates are such a huge factor.
Exactly, and inflation, right? It's always considered somewhat of an inflation hedge. I think of it as one of many asset classes that you probably want on your portfolio. You don't want a huge position. You don't want it to be your only position. But for the right risk profile for investors, I think you should have some gold or gold exposure. Certainly working.
All right, hold that thought. Move over NVIDIA. On today's Who Wore It Better, we're going to be looking at consumer staples, healthcare, real estate investment trusts, and utilities. These are historically defensive sectors. And while they're in the red since the election, they're respecting some big technical levels, and they're solidifying their long-term uptrends. And defense is great, but we got to pay the bills, right? And if 2025 is another year of outsized returns, you're going to see that in the growth year and more cyclical sectors. So there we have consumer discretionary, the flip side of retail, those items that we want but don't necessarily need. And then you have financials, which like the prospects of a light regulatory touch, and don't count out the growth names in tech either. So Rob, the question is, who is wearing the 2025 market environment better? Is it the high-flying cyclicals and growth names, or is it the steady, netty defensive that saved the day?
Yeah, great question. I mean, let's start with what generally drives a bull market. Growth stocks and cyclicals, right? The economy's in decent shape. The growth stocks should do well. The cyclicals should equally do well. And I think people have invested in those stocks. We just look at the returns that we've seen since, say, the third quarter. Financials, industrials, some materials, lots of consumer discretionary have worked. And particularly after the election, those stocks all had a bit of a sugar high, right? They took off very strongly. And it makes sense. It looks like there's more deregulation coming back. But these stocks have also run. So they're not the most timely new ideas. I think a lot of capital's already flown in those.
I mean, this could have been priced in months ago.
It certainly looks that way. And so these things tend to run, and then they pause, and then they run, and then they pause. And so I think we're getting close to a pause point in a lot of the cyclicals as we move into the beginning of next year. And then we look at the defensive areas, staples, healthcare, utilities, REITs. Utilities are a little bit of a different example right here.
Sure, that's kind of an AI play.
Right. So, but if you think of the other classic defensive sectors, they've been sold off. Very weak in relative performance, right? They haven't performed at all since the fourth quarter of 2022. Which is what you'd expect. In a bull market, you have offense on the field. But if you look at them from an absolute price standpoint, a lot of these have pulled back over the last 2-3 months, and they're at support. So if you're concerned about valuations, which many people are, it's a big issue for a lot of investors, and you are trying to diversify your portfolio, I think some of these more defensive areas make sense for the right type of client that are looking for a little bit more diversity in the portfolio as opposed to having only offense on in their portfolios.
Real estate investments trusts, it's defensive?
Well, yeah, I mean, real estate is something, it's defensive because it's interest rate sensitive. And so that can be counter-cyclical. And then you've got other forces at work in real estate. Any ideas there?
I think the REITs, look, they had a bear market between 2021 and 2022 into 2024. Right, as rates were steadily moving higher, that was a huge headwind for REITs. I think they bottomed. Now, they're going to move up and down inversely to where the bond yield, the 10-year bond yield's going. So currently they're pulling back, the 10-year bond yield's bouncing a little bit, but in general, I think they put in big bottoms, and I think they're an attractive investment for those people seeking yield.
If you have a long runway, is it better to just get in these growth names and avoid some of these other names? Or you really
like the defensive ones?
Yeah, like
we've been asking that of some other guests. Like, if you're younger, do you want to just go for the high beta?
Well, I think it depends on your age group for sure. But if you're younger and you have a long investment horizon, I think the growth stocks are where you want to be. But that's a bumpy ride.
Yeah,
and a lot of those stocks can go down 30-40%, and suddenly, when your stocks are going down 30-40%, you're no longer a long-term investor. Suddenly you need to get out. So, you got to be pretty realistic about what your investment horizon is. And that's why I think you want to go back to that 4-year cycle that we talk about, because those cycles are what really drive the returns over a sort of that 3 to 4 year time frame.
Can I say something weird? Like,
please say something weird.
If you're going to diversify, should you just get into every sector a little bit? And from there, okay, so maybe more of your money goes into growth and less of your money goes into some of these other sectors. But do you just put some everywhere?
Well, the easiest answer is just invest in the S&P 500.
Yeah, of course.
Yes, S&P 500.
As about as passive as it gets.
Yeah, or the equally weighted index, right? So you have that balance between lots of growth stocks and the rest of the market, which is pretty balanced and probably better priced. But I think it's all about the cycle. Where are we in that cycle? When you're at the bottom of the cycle, you want to get aggressive, you want more growth, you want more cyclicals.
Mm-hmm.
As you mature into that market cycle, again, lasting 3 to 4 years, I think we're getting to that point as we move into 2026, probably want more defense in the portfolio.
We got a minute left. We haven't really talked about small caps. Just wondering, because with the Russell 2000 at record highs and the S&P 500 600, S&P 600 above that, what do you think of small caps?
Yeah, look, again, it's an issue of what happened to the 10-year bond yield. It bottomed in the fourth quarter of 2023. The yields peaked and small caps, mid caps took off. Basically, breadth in the market expanded dramatically, and I think that's the second leg of the bull market. So mid caps led. I still prefer those over small caps. In small caps, you want to stay with the more profitable companies. That's the S&P 600. But in general, I think that was the low. They're still relatively early on in their recovery. So I think there's more room to run in small caps. I'm not convinced they're going to be sustained long-term leadership. In big bull markets, large caps tend to continue to lead.
For most people, do you think like an ETF following a small cap sector is best than getting into actual names?
Yeah, if you're a stock jockey, I think you could dig down. I mean, that's lots of fun. But I think for the average investor, just have a little bit of that in the portfolio through an ETF.
Guess what, guys? It is time to wind things down here at Stocks in Translation. Be sure to check out our other episodes of the show on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. You know what they are. So leave a comment, subscribe, and we'll see you next time on Stocks in Translation.
Welcome to Wealth. I'm Madison Mills in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to know to grow your money. On today's show, the 10-year Treasury yield hovering around 4.5% on this final trading day of the year. We'll discuss how you could take advantage of higher yields in your portfolio and how yields also impact your broader financial health. Also, changes coming to minimum wage, Medicare drug prices, and Social Security as early as January 1st. We'll get you the latest updates that could impact your money. Plus, it's time to set New Year's resolutions for your retirement. We'll dive into everything you need to know if you hold a 403(b) or 457 account. But first, let's take a look at some of the market action 90 minutes into the last trading day of the year. We are starting to see stocks recovering just a bit. The S&P 500 hovering above the flat line here, though the Nasdaq still remaining in negative territory, down just a little bit there. But I also want to flip the board over to treasuries, because the movement we're seeing in treasuries could lead to a better picture throughout the day for equities. We are seeing treasuries falling off their highs of the day, the 10-year in particular down just about 4 basis points at the moment, still hovering around that 4.5% level. If we do see more movement to the downside in treasuries, perhaps that helps equities get a lift as we head into the close of the final trading day of the year. Sticking with treasuries, though, our next guest thinks that yields could return to their 2023 highs in the new year. Let's bring in Andrew Cry. He is Crescent Grove Advisors Co-Chief Investment Officer. Great to have you on. So talk to me about your anticipation, Andrew, for the 10-year in 2025 and why investors should care.
Yeah, I think if you look at the trajectory of the 10-year, we saw this move downward for a period of time, kind of an overshoot, we thought, and you kind of reverted back to this, mid 4% level, which is kind of roughly the mid-range of where we saw, 5% being the kind of cyclical high 2023, down to the high threes. We feel like it's a little bit more of a balanced point now, but I think the perspective that we're taking going forward is if you're looking at a Fed that's potentially sort of pivoting to a more hawkish stance in the new year as they're grappling with inflation that's sort of stubbornly high. If you've got this concern growing about the deficit in the US, and you've got reasonably good nominal GDP as a broader sort of contextual backdrop for all this, we kind of think that there's an asymmetric risk at this point for the 10-year yield, meaning, it could push up higher towards 5% or even break above 5%. Relative to the potential for it to go much lower than, call it 4 or 3.5%. So for us, we want to be thoughtful about how that then translates into fixed income allocations on behalf of our clients and just be a little bit more defensive in terms of the duration exposure we're taking, the interest rate sensitivity in their portfolios as a function, again, of that sort of asymmetry that we see.
So let's dive into exactly that for our audience of retail investors. What are you telling clients about the opportunities in fixed income, and how attractive does a 5% yield become if you can just kind of park your money in the 10-year and get that kind of a yield?
Yeah, so there's an element of this where, if you're a retiree, if you're living off fixed income and you've got the ability to lock in a yield for an extended period of time, which is essentially what this kind of sort of duration concept is telling you, that you can go out and you can buy a 10-year treasury and perhaps, at some point over the coming months or quarters, you're able to lock in 5%. That can be a really interesting proposition where you essentially solve for your cash flow needs, right? So we don't want to discount that. But in the meantime, if you think about, sort of the balance of risk and reward in a portfolio, you've got the option of, let's say, holding money market or shorter term treasury, shorter term fixed income instruments that are still at this point yielding, call it, low 4s, mid 4s, somewhere in that vicinity, not too different from where the 10-year is. And if the 10-year does sort of push higher, you've got this phenomenon where yields go up, prices go down. So you're going to experience a negative return in all likelihood to the extent we see a 30, 50 basis point move higher on the 10-year yield. Is it worth sort of stomaching that risk in your portfolio right now relative to holding those shorter term instruments and seeing if there's a better entry point? Of course, it's sort of a balance. It's turning a dial. It's not flipping a switch on or off necessarily for an investor. But we just think right now, there's a little bit more risk to the upside for rates. So perhaps don't go all in to lock in that 4.5% 10-year treasury yield right now.
Well, and for those investors who are maybe a little bit more passive and perhaps don't have the investment hygiene for active portfolio management. Talk to me about how the yield on the 10-year impacts their investments otherwise. I'm thinking about something like high yield savings accounts or credit, for example. What can you tell us about some of those personal finance impacts that the yield on the longer end of the curve can have for folks?
Sure. So, the longer end of the curve really isn't going to be germane necessarily for what you're looking at from a money market yield, a savings account yield, those sorts of things. So, that's really going to be more what the Fed is controlling through their policy rate mechanisms, the Fed funds rate. When you see that the Fed cut 25 basis points, that's where you're going to get that flow through into your money market savings type yields. The 10-year, however, it has a variety of different impacts and sort of knock-on effects in somebody's financial life and in broader capital markets, not least of which is just looking at sort of that, what can I get for extending out the duration, for locking in, some period of time with my portfolio. And then if you think about sort of the derivatives off of the Treasury market, everything that's priced off of that base rate of a 10-year Treasury, let's say, that's even municipal yields generally. If you think about investors that want tax exempt income, it's going to be some sort of relative ratio versus a Treasury. So Treasury yields are going to impact that. If you look at credit, certainly, higher yield credit, let's say below investment grade or even investment grade credit is going to trade off of the Treasury yield as a base rate. So right now we've got really low spreads, meaning investors aren't demanding a lot of extra income to own things that are more risky than the full faith and credit of the U.S. government, corporate bonds and so forth. But there are periods of time where those spreads can expand. But all told, it's going to come back to that 10-year Treasury yield or Treasury yields more broadly on the long end of the curve that helps set sort of where those yields are across all these different other areas of the fixed income environment.
So, Andrew, finally, for investors who are looking at high yield savings accounts, have they missed the opportunity there because of what we are potentially going to be seeing from the Fed cutting more moving forward? And how do you kind of advise clients on an opportunity like a high yield savings account for maybe short-term expenses versus parking their money in bonds where they could potentially see higher return for less taxes on withdrawal as well?
Sure. So we would say you haven't missed the opportunity at this point. I think it speaks to the idea that, again, locking in a longer term yield today may come with a bit of risk from, the fact that yields could potentially move to the upside. So we think that there is still very much a place in a portfolio for those sort of shorter term instruments, something like a savings account, a money market account, those sorts of things. So, in this environment, we still think that that makes a lot of sense. What I would say is relative to a money market fund, let's say, there are some sort of ultra short or shorter term bond options, which provide a little bit of a middle ground. They're ETFs that you can express these sorts of themes in your portfolio. But we think there's an area there where you can actually pick up some yield incrementally relative to a money market fund, again, or go back to the savings account idea, that presents a little bit of an interesting risk reward proposition where you're not quite taking on the full risk of those longer duration instruments, but you're still earning a little bit of incremental yield. And all this comes back ultimately to the Fed, where we think that they're probably going to be a little bit, they're going to be in a bind this year a little bit, where inflation is going to stay stubbornly high. They're not going to be able to cut quite as much as they had forecasted initially, and certainly as much as the market was expecting. So that should provide sort of a floor underneath those shorter term yields going forward. So that's why we're a little bit more sanguine, let's say, on that part of the yield curve or that part of the fixed income environment relative to those longer duration bonds right now.
All right, Andrew, thank you so much for joining us. We appreciate it.
Thanks. Happy New Year.
Happy New Year. Thank you. It is the final day of 2024. There are lots of changes ahead when the clock strikes midnight for your wallet. Here's just a few that could impact your finances in 2025. First, the minimum wage is set to increase in 21 states and 48 cities and counties across the country. 8 of those states and 47 cities or counties are set to raise minimum wage to $15 an hour or higher later in the year. Florida and Oregon will also raise their minimum wages later in the year as well. Next up, student loan borrowers will now have to resume payments or see their credit scores take a hit. TransUnion estimates delinquent borrowers could see their credit score lowered by as much as 129 points. So don't forget to turn that auto payment function back on for your student loans if you can before that New Year's clock strikes at midnight. And some good news for seniors. Medicare out-of-pocket drug costs will be capped at $2,000 a year. That rule applies to all prescriptions issued under Medicare Part D. Additionally, those seniors will get a bump in Social Security benefits due to the government's 2.5% cost of living adjustment. And finally, the maximum amount of income subject to Social Security tax will increase from $168,000 a year to $176,000 a year. So a bit of relief in terms of taxes paid for those individuals receiving Social Security. We've also got some good news for potential home buyers when it comes to prices of those homes. The growth of home prices is starting to moderate. The S&P CoreLogic Case-Shiller Home Price Index climbed 4.2% year over year in October, but that was slowing from 4.6% in September. So what does this signal for prices in the new year? We've heard from a host of experts in the last few weeks about their outlooks for the housing market. Here's some of the best sound that we got.
So I don't think we're going to see mortgage rates move all the way back down to where they were over the last few years. Our expectation is that we'll see mortgage rates edge down to 6.2% by the end of 2025, and that'll mean an average mortgage rate of 6.3% across the year, because we expect home prices to continue to climb, but not as quickly as we saw in 2024. That means that those falling mortgage rates will basically help offset that gain in home prices, and monthly payments will be relatively flat. If we combine that with a healthy economic backdrop, which we expect, it means incomes go up, and we should see affordability improve very modestly for home shoppers in 2025. I still expect spring to be the peak season, but I do think as mortgage rates come down throughout the course of 2025, then we're likely to see some improved conditions in the second half of the year. But again, spring and summer is still going to be that peak home buying and selling season.
So we think the market will be a bit better next year, but not a whole lot given that mortgage rates still remain quite high.
What's the magic number that you're anticipating on the mortgage rate front where we could potentially see some averaging out?
Well, prices are already reflective of current mortgage rates, so we're going to see sales even with these high mortgage rates. If mortgage rates were to come down, say below 6.5%, something closer to the 5 range, then I think we would see a large burst in demand, more bidding wars, more price growth than even what we're anticipating right now.
Certainly, and taking a look at some of the predictions here as well, even as we're showing that 6.8% rate on the screen for our viewers here, you're also anticipating that home prices will still rise 4% in 2025. Why is that?
Well, a lot of people have been delaying buying a home thinking that mortgage rates were going to fall. And now that it looks like mortgage rates are going to stay pretty much where they are, there's no reason to wait anymore. So even though rates haven't come down, we do expect more buyers to come back. Also, the economy is growing, and some people are really ready to buy a home and can pay in cash to avoid those high interest rates. So I think demand is going to be stronger.
Given the higher mortgage rate environment, Zillow does expect probably fewer new listings from existing owners than we did just a couple months ago moving in to that next year. That said, we still forecast a steady improvement. That's going to be particularly true with more new listings come in the lower half of the US. This past year, that was the case in Florida and Texas, where we saw buyers markets and rising inventory. We expect that to now start moving into the Southwest. For similar reasons that you think of, when I think of the lower half of the US, those are owners that are less locked into their mortgage. So they're less locked in when a major life event happens, like say they're ready to retire, move down, move up, more kids. They're more able to do so because that housing market is actually still functioning and moving with available listings. That will be more the case moving forward, I think, in more areas as inventories start to rise and buyers experience affordability challenges. So not everybody can move forward, right? Over time, I think we're going to have a softer housing market in 2025, but steadily going towards normal.
Well, I think we're going to see that certainly as we move into 2025 and into 2026. With the persistent lack of lots, or at least I'll say affordable lots, really that's the lifeblood of the industry is land. You add on to labor and of course regulations and NIMBYism, and you have the makings for a difficult housing market moving forward. But I think if we look at ways that we can release those lots, I think that is the one thing I would ask local governments to do is we get ready for what I think is going to be a golden age of housing production over the next 4 or 5 years. We really need to get those pieces of land in the pipeline now, and we need to get them in there affordably so that we can meet demand in the future.
The home sales have been rising recent months after being stagnant in the early part of the year. And the reasoning is very simple. We have more inventory. So more inventory is bringing out more buyers. We know that the mortgage rate is not fully behaving as the Federal Reserve has been cutting rates, mortgage rates stubbornly refusing to decline. But the more inventory, more choices for consumers are bringing buyers back into the market. That's why it is critical that the builders ramp up production in the upcoming years. So I do believe that the builders need to produce more and will produce more, thereby providing that golden years upcoming.
The world's richest people got much, much richer in 2024. During the year, the combined net worth of the top 500 wealthiest people in the world surpassed $10 trillion. Across the board, the richest folks, like many investors, benefited from a strong stock market over the last 12 months. But who is the biggest winner? That would be Elon Musk. Thanks in part to his friendship with Trump, the value of Musk's companies surged during the year, especially after the election. That helped boost his fortune to a whopping $442.1 billion and solidified his position as the wealthiest man in the world. He's not the only Magnificent Seven executive who added to his wealth this year. Meta CEO Mark Zuckerberg saw his personal fortune grow by more than $80 billion. The company's stock has gained nearly 70% year to date. And NVIDIA CEO Jensen Huang's net worth surged 173% this year to $120 billion total, thanks to NVIDIA's soaring stock price. Coming up, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss, so stay tuned for that. Plus, we're continuing our retirement resolutions with a deep dive into 403B and 457 accounts. That's coming up right here on Wealth. Stick around. We're 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. U.S. stocks mostly lower, having given up the session's earlier gains on this final trading day of 2024. Still, the S&P 500 set to close out its second consecutive annual gain of more than 20%. Argus Research issuing some upgrades this morning as well. Analysts raised their rating on Ralph Lauren to buy from hold, citing stronger international demand to come. Yum Brands also upgraded by the firm to buy, thanks to solid same-store sales. Analysts Analysts also cited success with the company's AI-powered marketing initiatives. And Tesla set to release its latest delivery and production numbers on Thursday. Analysts are expecting record-breaking fourth quarter deliveries from the EV maker. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, you can scan the QR code on your screen and track the best and worst performing stocks of the session. We'll have more on wealth when we come back. "44% of workers who have an employer-sponsored flexible spending account, or FSA, leave money on the table. The average amount usually left unspent is $370, according to a Breeze FSA database. Now, time is almost up to spend the last of the cash in your account before a new plan and a new year begins, and that money then goes back to your employer. You don't want that to happen. So here are 3 ways to spend the rest of your money before the year ends for your FSA. You can buy a big-ticket item like wearable health trackers, red light therapy masks, my personal choice, or a massage gun. Speaking of those massages, with a prescription from your doctor, a massage could be paid for with your flexible spending account. It's also a good way to use up any extra money that you don't want to lose in that account. And lastly, you could stock up on your medicine cabinet. Think of those essentials like cold and flu medicine, pain meds, allergy relief, even vitamins. All of that can be purchased through your FSA. A bonus idea for anyone visually challenged, you could get yourself an extra pair of glasses, also prescription sunglasses and contacts before the year ends. Make sure to put on your calendar that deadline for your FSA so that you use up all that money. And this week, we want to set some New Year's resolutions to optimize your retirement savings. Each day, we are doing a deep dive into different types of retirement accounts. Today, it's all about 403B and 457 accounts. So here are some tips and more. We've got Ann Lester. She's a retirement expert, speaker, and the author of the book, Your Best Financial Life, Save Smart Now for the Future That You Want. And great to have you on. Thank you for joining us on this New Year's Eve. Just want to level set to begin. For those who are not familiar with 403B, 457 plans, talk to me about what they are and how it relates or is different than a 401k.
So they're all basically flavors of the same thing. A 401k, a 457, a 403B are all sections of the tax code that set up the tax-exempt status of your retirement savings. Basically, you can contribute money before taxes and not pay taxes on it, or you could do a Roth 403B, 457 if your employer offers it. The reason there are these different numbers is because of who you work for. Companies, profit-making companies, or 401k, public schools, churches, and other kinds of tax-exempt organizations like hospitals offer 403Bs, and government, state and local governments offer 457, but otherwise they're all kind of the same.
So they're all kind of the same. That tells me that the advice is similar across the board. So what is your biggest piece of advice for folks on their retirement accounts?
To use them. Number one, make sure you're in them. This time of year, a lot of people have just gotten raises or maybe a bonus. And one of the most helpful things you can do is try to save half of that. So if you got a 5% raise, see if you can bump up your savings rate by 2%. That is going to make your financial future a much more successful one, especially if you get a match from your employer. That is, many employers will match half of what you put in. So if you're putting in 5%, they'll put in 2.5%. If you put in 10%, some employers will match up to 5%. Make sure you're getting all of the free money.
How do you make sure, how should investors and retirement folks make sure they're getting that match?
You've got to look at your company's retirement website. Every plan is structured differently, right? These are voluntary benefits. There's no sort of across the board rules on how they work, aside from some sort of guidelines about what is legally permissible. So each company may do that match differently. Some companies may match a quarter of what you put in up to 20%. Others might match 100% of what you put in up to 5%. So you've really got to dig into the website and understand what those match levels are. But just remember that match is free money, and that is going to completely accelerate your retirement savings. It's rocket fuel.
Right, and no need to leave that free money on the table.
Absolutely
Ann Lester,
not.
thank you so much for joining us, and Happy New Year to you.
Thank you. Happy New Year.
We're going to do a final quick check of the markets here. You're still looking at a mixed picture across the major averages, actually turning to the downside, reversing earlier gains. The S&P down about 0.2%, the Nasdaq down 0.4% here in the last half hour, seeing that movement to the downside really picking up here in this final trading day of the year, looking like markets are not on track to move through that Santa Claus rally, but we could still see recovery, of course, as we do head into January here. That's going to do it for Wealth this hour. I'm Madison Mills. Thank you so much for watching our show today, and stay tuned. Market Domination with Julie Hyman and Jared Blickery is going to be coming up here on Yahoo Finance at 3 p.m. Eastern. You won't want to miss it.
Welcome to Stocks in Translation. I'm Jared Blickery, along with the voice of the people, Sydney Freed. Thank you for joining us. And a few quick notes. Please go ahead and like, subscribe, and comment on Stocks in Translation on Spotify, Amazon, Apple Music, YouTube, or your podcast platform of choice. Today, we are welcoming Dimitri Kofinas. He is a host of the Hidden Forces podcast and a veteran of radio and TV. Full disclosure, Dimitri was the first to ply me onto TV way back in 2012. It is great to see you here today. And today, we are going to be talking about the tectonic shifts in the financial world that are underway right now. Our phrase of the day, financial nihilism. It's a phrase Dimitri here coined and has been using since 2020. Is there more to finance than ever higher prices? And this episode brought to you by the number 1.1 trillion. That's the total amount of dollar-denominated debt of mainland China. Why the US dollar isn't going anywhere as a global reserve currency anytime soon. Now, regardless of the media hype, Dimitri, this has been a really interesting time. Over the last month, we've seen some wild market movements, and I've been asking every guest, what are you making of the financial markets overall right now?
Well, you and I were talking about crypto earlier in the context of financial nihilism, and that's one area where I think you really see this. And, again, you mentioned that we've known each other for a long time. I think also the 2008 financial crisis was very...
it permanently lives in my psyche.
Totally. Like, we are kids of that era. And I think a lot of people were influenced by not the 2008 financial crisis itself as much as the aftermath, the lack of accountability, the blowing out of the Fed balance sheet, the ultra low interest rates for years and years. And I think that bred this kind of what I describe as financial nihilism, and crypto is sort of the epicenter of that.
I want to get to the definition here. So let's do that first, and then we can get to all the conundrums of this concept. So financial nihilism, and this is a big term, and as I mentioned, I think you first used it in a 2020 pre-pandemic podcast with Ben Hunt, Grant Williams, and this is the definition. Financial nihilism is a belief that financial planning, investing, or wealth building is meaningless or futile. And we've seen this. In its most basic form, financial nihilism views the objects of speculation as intrinsically worthless.
So I would say, I'm not sure who sort of added that initial part. What my definition of financial nihilism...
It was AI.
...has always been, yeah, I know. Apparently, it was ChatGPT. ChatGPT also in the initial phases thought that I worked at Elevation Partners or something like that. I remember, which is not true, by the way. Not that there's anything wrong with that. My definition of financial nihilism, so I coined the phrase in 2019, and you're correct. I used it first time in a podcast titled, I think, Financial Nihilism or Market Nihilism and Price Discovery in a World Where Nothing Matters. And my definition of financial nihilism is more or less an investment philosophy that treats the objects of speculation as though they were intrinsically worthless. Now, I'm sure you're familiar with Karl Popper's or George Soros's building on Karl Popper's theories of reflexivity, and that there's a relationship between price and value.
No, I'm not familiar. I was going to chime in.
She's actually speaking for me a little bit too.
Yeah, but so that sort of informed my view of it, which was to say that I've always understood that there's a discrepancy or a disconnect between price and value, and that markets are about finding the intersection between those 2 points and trying to buy below at a price below value, and eventually the thing appreciates in line with expectations. Or with underlying value. In the case, when we think of a world that has become increasingly nihilistic in terms of its investment framework, we think of a world which dispenses with one half of that ratio. It dispenses with the value proposition, and everything becomes about the price. And in some ways, it's sort of like, it's like art. But what drives price at that point becomes essentially momentum and narrative. And I think that's another phrase that I used around the similar era was narrative investing. And we saw this again in crypto. And I think, again, the reason why crypto has been the epicenter or such a trailblazer in this regard, because we've seen this with Tesla too. We've seen this with other stocks. Tesla's not the perfect example of this because there is an underlying value. But we've seen it with GameStop. We've seen it with even Hertz, which is a closer analog, which went bankrupt and the thing went up. And I think, the term I've also used is narrative investing. And we have seen a kind of self-awareness in the internet age around narratives that didn't exist when we were younger, where people really focus in on the narrative. What's the narrative? Let's get a narrative going. You see it in all these Discord channels, Telegram channels, Reddit, 4chan, et cetera, where people focus on telling a story. They know in a cynical sort of sense that they're telling it. It doesn't matter. And as long as we can get more people to believe it, even if they know it's also BS, we all click our heels 3 times and we kind of send the thing up. And so markets have become a casino, and and you've seen that casinification of markets permeate more and more asset classes. But the epicenter of that, I think, is crypto. Not a knock against crypto. It's not a thing about what is crypto itself.
You're going to get a lot of letters off this.
I'm sure I will.
But Sid,
I want to be clear, though. Are you saying financial nihilism is a good thing or a bad thing?
I think it's a bad thing.
Okay.
I think it's a bad thing because the reason that capitalism works, both in theory and in practice, is because there is a reward for speculation that is tied to the fundamental productive capacity of the economy.
So in other words, I think what you're saying is we're getting too much away from value and we're just focusing on price. Is price going up? That's all we care about.
Yeah.
I mean, to be succinct there. And we've seen this a lot, but you mentioned markets as a casino. Were you just talking about crypto, or are you talking about the capital markets as we know them, stocks and bonds?
Obviously, crypto is the area where you see this more than anywhere else.
And it's a loaded term too, casino. So just kind of elaborate on what you're saying.
I really feel like this latest pump that we see in crypto in the altcoins, everything below, again, like Bitcoin has proven its value proposition as the biggest, it has the biggest network effect. So it makes sense from the store of value standpoint. We can get into the nitty gritty of it, but it makes sense from that point of view. Further down, and let's just put Ethereum aside, what we have is basically an incredibly large market cap for a paltry number of apps that do anything other than, work to be basically financial assets. And this is very different than if you think about, this is now we're in year 16. Right? I mean, Bitcoin came out in the fall of 2008, at least the Bitcoin white paper. Ethereum was launched, I think it was in 2014 officially.
Sounds about right.
And so we are in 16 years of this. Now, if you remember, 1991, was it when Netscape launched? Or I think that
was about the same time. I mean, and that was when we were getting the first ETFs. So we're talking about financialization. There's another trend that started.
Yeah, so we had 10 years, not even 10 years of apps, Google, platforms, Google, search engines, Yahoo right here, still around.
Yeah, we are.
eBay, Amazon. You had actual applications and services and things like this that were web-based, that had value, that were adding value before they even went public. Yeah, Google didn't go public until I think 2004, but we were using it in high school to actually do stuff. That isn't the case here. And I think, again, there's one more thing that if we have time, we can talk about it, but I think also when we think about crypto as a category, not really to focus too much on it, it was the merger of a core part of it was crowdsourcing, and the idea was that absent the government, DoD, DARPANET, ARPANET, the universities, absent that funding to help provide the seed capital to launch the next internet revolution, with the equivalent of the internet revolution, we'll crowdsource that to the marketplace. But what's happened is because of the easy exit liquidity in crypto. That's what makes it especially nihilistic. It's like you can get in and get out. It's
too easy to get in and out.
The incentives don't align, and that's happened more and more across other areas of the marketplace.
So how do investors kind of cut through this financial nihilism and find value?
You embrace it.
That's too easy.
You sound like you're sitting by the poolside here. You're just sipping and watching the world crumble. You really just embrace it.
I have to say, it's not far from the truth. I mean, it's not entirely true, obviously. But there is a part I've sort of been that guy railing against the clouds as the Simpsons character, and I feel like in general, there does seem to be a decadence in our society and a kind of corruption in our politics and in our markets that wasn't there to this extent years ago.
Do you think it was there, just not realized, or it's prevalent?
I think it was more contained. I think that it has spread. And
there's usually a pendulum, though. So if it's gone too far this way, might we expect, there's going to be a movement in the opposite?
That's a good question. Sometimes it just goes off and then the cord breaks and the ball goes flying.
Wow. Okay, that's true too.
Yeah.
Sometimes. I don't really have a follow-up to that. So
I have a non-market
please go
one.
for it.
When you're talking about this, I'm starting to think about fast fashion as something more about price and less about value. What do you think about that?
Topic.
So fast fashion is what exactly?
I just think like that's all price based. Like I'm buying 50 things,
that you buy
the
at
cheap
a
goods.
clothing store, you wear it twice, and it's kind of
Exactly.
disintegrates.
I don't know. It's just a thought that came to mind when we talk about non-investing.
Yeah, I'd probably need more of an explanation of what fast fashion is so that I actually make a
like really cheap really cheap stuff, so it entices people. Like, oh, the shirt is $8.99,
But it doesn't survive
last.
5 washes.
No value. Yeah, exactly.
Yeah, I mean, I think that the analog that comes to mind there is like kind of like ICOs or things that are just kind of thrown in the crypto space out of nowhere that are suddenly pumped. They get exciting because they have a low market cap. No one owns them. We can pump this thing. Like I've seen that. I don't know if that's a good example, but I think generally fashion and better so art. There was a documentary I saw years ago called, I think, The Price of Nothing or something like that. It was about art. It was about the art world and like,
which is becoming tokenized now.
There you go. And like more and more of the world kind of resembles that signifier. More and more of the financial landscape becomes associated with the signifier and not with the signified.
We're going to pause right here, do a really quick break. But coming up, we're going to be talking about the demise of the dollar. Spoiler alert, not even close to anytime soon. And a look at the very future of humanity on today's Who Wore It Better? All right, we are back, and this episode is brought to you by the number 1.1 trillion. That is dollars, the total dollar-denominated debt by mainland China. So-called external debt because they're not borrowing in their home currency. They're borrowing in over $1 trillion that has to be repaid in dollars. And this is in light of rumors circulating, Dimitri, about a new global reserve currency centered around the China-Russia axis, the so-called BRICS. But the point of highlighting these debt figures is that the world is neck deep in dollars, heavily invested. Global reserve currencies are not made overnight. And so the world as it is couldn't just flip a switch and turn off the dollar spigot.
No, you know, this is a great, because there's so many misconceptions around the dollar. One of them, generally speaking, is that the conversations about the demise of the dollar are really a sort of way of materializing a roving anxiety about the future of the American economy, the future of American power, American empire.
But not necessarily linked with the dollar there.
Right. There's
especially on a short-term basis.
Right. It's the signifier. It's the thing that people are focused on. But to the extent that the dollar, we're going to have a conversation about the future of the dollar. I think that, one of the main misconceptions about the dollar that people have is that they think of it as this thing that Uncle Sam generates and that the rest of the world takes or is forced to take. And in fact, the dollar is arguably the most decentralized currency that exists in the world.
I love this. Expand on that, please.
It's decentralized because while it's true that the Federal Reserve has the ability to generate dollars out of thin air, so does, there's a difference, of course, between a Fed dollar and a euro dollar, but trillions of dollars are created outside of the U.S. Federal Reserve banking system by third parties, banks, other financial intermediaries, people outside the U.S. that have no relationship to the banking system whatsoever, invoice in dollars, contract in dollars. And all of that is a source of dollar demand because those debts need to be repaid in dollars, which is why the Fed operates swap lines. And so
with other central banks so they can exchange
exactly. So it's a very sticky system. It exists, again, it's decentralized. There are huge network effects associated with the dollar. So we recognize the network effects with Bitcoin, the power of those network effects. We recognize the network effects in gold. We don't seem to recognize those same network effects operating in the dollar-based system. And
that's really interesting.
And it's very difficult to displace those network effects. It's also very difficult to scale a currency. And the idea that the BRICS currency could compete with the dollar is so asinine that I haven't even done the work to investigate further the details of it. And you can just think of it, I mean, if there's ever going to be a competitor to the dollar, it would be something like the Chinese renminbi. The BRICS currency is an association of international countries, some of which are geopolitical antagonists like India and China.
Not the best of friends.
Not the best of friends. Permanent, long-term divergent interests. The idea that this group of nations can come together to do what the European nations couldn't, which had a common security architecture, which had a common marketplace.
Fiscal union.
A fiscal union built over decades of treaties. And a common sort of geography, that these countries couldn't make it work, but that the BRICS are going to make it work, that Brazil, Russia, India, China.
And the other thing is in the network, thinking about the network effects, part of that is the legal system that we have. And you and I were talking about this earlier, that if you're an investor in a Chinese company that goes bankrupt, what is the liquidation process? What is the bankruptcy process? Do you trust the rule of law there? And then you multiply that. You mentioned companies doing contracts in dollars when that might not even be their home currency. It's all kind of buying into this notion that there's somewhat of a fair playing field in the US. In the West, can that be replicated somewhere else?
Absolutely. So that's the other important point, which is if we acknowledge that the idea that there's going to be a BRICS currency, and again, I really don't understand how this ever got any traction, but regardless, other than just general dollar FUD, the real potential competitor is China, but that requires, as you said, both for people to trust their legal framework, a country that, let's say, can just put the head of the biggest company, the biggest tech company, Jack Ma, in prison or somewhere, disappear him for a period of time, take his assets.
Right.
It doesn't make you feel very safe. But also they have to open their capital account, they have to liberalize their financial system, or they could go the route that they're trying to go, which is to digitize the yuan in terms of a CBDC.
And just look what happened with the DD IPO. There were investors who were sitting on some profits, and then all of a sudden, the DD, which had listed in the U.S., Chinese regulators forced them to delist in the U.S., and people got a big fat red marker in their account.
Yeah, I mean, again, the dollar has been, there's a really great book, actually, I recommend if people are interested in, there are actually a few great books, but one that comes to mind is, it's a biography of Charlie Kindleberger, but it's really a biography of the dollar and the internationalization of the dollar, written by Perry Mehrling, which tells this story, because this was a long process, and it takes a long time to happen. People don't just adopt a currency overnight. Again, the Chinese strategy for displacing the dollar, to the extent that there is one eventually, is the digital RMB. It's very much in the vein of a CBDC. It includes the digital Silk Road infrastructure and this idea of sort of building out. It's very Chinese in that sense, but that's a long ways from happening, and it's not clear that it'll ever happen. The dollar could be around longer than the U.S. empire could be around. It has its own independent effects, just like English. People speak English as an intermediary language because it's convenient, not because anyone imposed it on them. It's similar for the dollar. In many ways, the future of the dollar is dependent more on what the U.S. does to undermine it than it is on other countries' willingness to divest themselves of it.
So USD forever? What's the US dollar's like biggest competitor?
Nothing is forever. Wasn't there a song, something like that? Nothing is forever.
Diamonds are forever.
Taxes are forever.
Yeah.
They say taxes are forever. Diamonds are forever.
Crypto? Could that be the new?
Diamond hands
Maybe
are not
Bitcoin
forever.
Could
Certainly, if you're
Bitcoin?
transhumanist, you're banking on that.
Well, yeah, it could
If you're cryo freezing your head and hoping to be regenerated in 100 years, like
I don't have that kind of money, so.
Is Bitcoin the future for the whole world?
You know, I don't know. I will acknowledge that I dramatically underestimated the network effects of Bitcoin. I was one of those folks who was looking at blockchain, distributed Nakamoto consensus, and thinking that, okay, this is a great initial horse and buggy, but there's something that's going to come along that's going to displace it. Again, this requires a larger conversation, but I think part of the reason that hasn't happened in crypto is because the incentives aren't aligned with development. The incentives are aligned with the pump. And
Kind of gets
driving
back to
number
that
go up.
financial nihilism. Let's talk about the fiscal position in the United States, which kind of ties into the dollar. But we've seen the pressure on long-term yields since the election, and part of that is just the anticipation of the U.S. having to issue a lot more debt. I don't know that it's anything new, but the exact strategy of how that comes about will be different. What do you think about this?
I think there is a concern because the Fed is now. I don't want to use the word prematurely. The Fed is preemptively cutting interest rates, despite the fact that inflation hasn't returned to target, which does seem to be incompatible with or inconsistent with the view that they're data dependent on concurrent data. If you are of the mind that the Fed is always steering with the rearview mirror in mind and lags are long and variable, you could make the argument that they're getting ahead of something. But what if they're not? And inflation persists or begins to rise, then the Fed is caught in a really difficult situation because they've given forward guidance that they're cutting interest rates, but now interest rates on the long end are going up, and the risk is that they could lose control of the bond market. And what if you saw a 50, 100 or more basis point move on the long end? That significantly tightens financial conditions because credit markets take their cue more from the long end than from the short end. And then what does the Fed do at that point?
Sounds like a long conversation with the bond vigilantes that we will have at some point in the future and check up on that. But I want to get to today's Who Wore It Better? We've got a contest that concerns the very fate of humanity. Will it be good or will it be bad? It will be topian, but will it be utopian or dystopian? So on the utopian side, we have the dreamers, dreaming of a world where technology is humanity's ultimate tool for progress. AI solves everything from poverty to climate change to human sickness and aging itself. Immersive tech revolutionizes education and entertainment, and somehow we walk on Mars without first blowing up Earth. On the other side, we have the darker dystopian view. AI steals jobs instead of creating them, exacerbates the wealth gap. Critical life-saving treatments go only to those able to afford, the rich, and a new generation decides to check out of the physical realm in favor of the metaverse en masse, closing the chapter on humanity as a species that thrives under the light of the sun and of the moon. Dimitri, future of humanity, utopian or dystopian?
Oh man, that's a difficult question to answer. I think, this is a topic that I've explored quite a bit on my podcast from different angles. I think the thing is that if you were to do a thought experiment and go back 100 years, better maybe 200 years, and bring a person forward from that era, you can make the argument that person would rather die than live in today's world, that everything would seem so obscene and alien. Signage, I mean, when electric lighting first came into Times Square, it was obscene. People were shocked by the sight. They found it to be an assault on their senses. And I think that the reality is that the human experience changes. What it means to be a human being in the world changes over time. And the question for me is more, will that change happen so fast that our children will live a life that is largely unrecognizable from our own? And you can make the argument again that there were periods where this did happen, maybe during the Industrial Revolution, during the period of the railroads, certainly for the natives in the plains who saw the buffalo extinctions and the trains cutting through their lands. Something similar may be happening in our current world. We spend so much more of our time online. And that also, in some ways, has an effective on undermining our democracies, because so many of the public conversations we have that filter through the media happen on servers that are controlled by private platforms. And there are a lot of people that have written about this. A great book that I would recommend for folks is Shoshana Zuboff's Surveillance Capitalism. And she was on the podcast years ago to talk about it.
Hidden Forces, by the way. Everybody check that out. So I'm sorry, was it utopian or dystopian?
Yeah, he didn't say.
I think I'm not trying to give you a cop out here. I would say I'm going to bet on it being utopian. I believe that we can figure out the challenges that we have to face. But we might go through a dystopian period.
Gotcha. So a little bit of a bump in the road, but long term, A-OK. That's what I'm going to bank on.
I think that too. I think the problem is like when people forget social skills more, like when everything is done behind the computer. I know. Or like
pandemic.
Or like with ChatGPT that you can, get a little lazy and not learn how to research yourself. You could argue that this is just the future of research, so why would you fall behind?
Well, that's a really great thing, bringing up ChatGPT and LLMs and AI. And I've thought about this too. Again, I think technology does make us lazy. When used properly, it can also make us it can help us specialize. So if you depend on ChatGPT to give you the answers, well, you're going to get worse answers because it hallucinates, at least current models
It does for me sometimes.
Yes, it hallucinated a little bit there, even with my bio, even though I was happy to see that it properly ascribed credit to financial nihilism to me, which is a big win. But I think that where ChatGPT is potentially explosively powerful is when it's working with an interlocutor who knows how to ask the right questions. So I think we're in an era now where we can get answers, but still the questions elude us. And people that are very smart, educated, capable of asking the right questions will be in a position to provide better answers than they were before, which is why I always recommend, I have people that are listeners to the podcast who are in high school and they're looking to go to college, and they ask me what should they study, and I always tell them philosophy and history, dual major. Learn how to think and then collect a set of data that you can analyze. And that is, I think, the future. I think I would love to see philosophy taught more, epistemology taught more in high school.
Guess what? 24 minutes has elapsed once again, so we got to close things off here at Stocks in Translation. Be sure that you check out all our other episodes on the Yahoo Finance site and the mobile app. We're also on all your favorite podcast platforms. Just to recap, that's YouTube, Amazon, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. It's all for now. Keep your dial tuned to Yahoo Finance.